The power of earnings is too strong.
Earnings revisions breadth is still surging.
At some point, valuations will become an issue for investors.
We've been warning our investors that a correction was coming across the board.
It's premature to get too worked up or too bearish.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, wrapping up big bank earnings. Morgan Stanley, BNY set to report following blowout numbers across Wall Street. PPI, the next data point to drop after CPI comes in much cooler than expected. Heading into day two on Capitol Hill for Fed Chair Kevin Warsh. Warsh facing down the Senate.
Yesterday, the message coming from Kevin Warsh was mission not accomplished. We'll probably hear more of that today, even if we get another softer than expected print on PPI. Question is, which mission is he talking about? Because when it comes to mission transformation or mission information, he seems to be winning. If you take a look at the two-year inflation expectations, they're near the lowest since October 2024, even with oil prices rising. So even though Kevin Warsh did not lay out his plan going forward for exactly how he planned to anchor inflation expectations, he has done so with remarkable care.
That's the issue. We know what he doesn't like. We don't know what he wants to do about it. Is this just a communication exercise, or is there some real intent? Is this about hiking interest rates at some point, or just holding rates at this level for a whole lot longer? They're the questions we've got to ask. I think today in the Senate, if you have an opportunity, good morning, senators, just ask him whether he believes we are sufficiently restrictive or not, based on the policy rate where it is right now and the economy that we have. Are we sufficiently restrictive or not?
Yeah. Do you think that right now, by doing nothing, we could still get inflation down to that path? He probably will say there's a task force to analyze inflation, which he did discuss and go into in terms of a default. But this really is going to be the key question. When you take a look at where investors are positioned, the Bank of America Fund Manager Survey came out for the month of July.
Punchy.
83% believe that the Fed will not hike rates before the midterm elections. And increasingly in notes, I see the expectation for a rate cut come in 2027 and being on hold this year. So despite market pricing, the sentiment from Wall Street analysts seems very different.
Looking at the same survey this morning from BofA, U.S. equity overweight is the biggest since 2024. Cash levels fall to an uber low 3.6%. That's a pretty bullish setup coming into this month. Check out crude, WTI and Brent. We've added about $10 back to the price of crude. 85 on Brent this morning. WTI at around 80 and up by 0.8%. The stress in the Middle East continues, and the flip-flopping around policy does as well.
Yep, we're flip-flopping in terms of potentially this 20% reimbursement. The president wanted to charge vessels for transiting the Strait of Hormuz. He now says it could be done in trade deals. So if you're a Gulf country, invest more in the United States. There's really no details on exactly how this would work, but clearly he's been advised that the United States charging a toll is not going to work the same way the Iranians are trying to charge a toll. However we want to slice it, though, the strikes continue. And the president in a Fox News interview last night not only said they were going to happen last night, but they're going to happen again this evening. And then he foreshadowed energy targets in Iran will be left, quote, for last.
How much comfort can you have in the inflation story? We just had the biggest decline in gasoline prices since 2022. How much comfort can you have with CPI yesterday, PPI later this morning, when this story can flip again, Bramo, over the next month?
You know, I don't really understand why two-year inflation expectations are as low as they are, why they are continuing to come down, why the disinflation belief seems to be prevailing on Wall Street, even though we do have rising oil prices. This is a tension that needs to get resolved.
Should we check out ASML as well, reporting over in Europe? The good news, that stock is doing well. That's the AI trade. In many ways, it's the capex trade. ASML this morning up in Europe by close to 4%. It's capex for the few, not for the many, and I think they're getting that capex. IBM certainly is not getting the spend right now.
Yeah, and arguably the two stories are highly intertwined, with people investing in the hardware of ASML and not in the software of IBM, really front-running some of these orders. The idea that their guidance for total revenue for this year came in almost $9 billion above the low point in previous expectations for the full year gives you a sense of just how much of a beat you're getting in the hardware side of things.
IBM just getting absolutely hammered in the last 24 hours. Coming up this hour, we'll catch up with Steve Chiavarone of Federated, wrapping up earnings on Wall Street. Anna Rosenberg of Amundi as President Trump walks back plans for a Hormuz toll. And Stefan Slowinski of BNP Paribas as IBM loses a quarter of its value in a single day. We begin this hour with stocks pushing higher, heading into earnings from Morgan Stanley and BNY. Steve Chiavarone of Federated writing, despite all of the headline risk and volatility, the relentless march of earnings growth continues to drive the market higher. Steve joins us now for more. Steve, good morning. Good to see you.
Good morning.
How high is that earnings bar going into earnings season?
It's the highest in a while. I mean, expectations are that earnings are going to grow 22% on a year-over-year basis. That would be the strongest quarter since Q4 of 2021, coming right out of COVID. We generally beat 5 to 8%. And so, is it impossible to see a 30% year-over-year earnings growth number? I think it is. I don't know it's likely, but it's possible. And it's broad-based. I mean, certainly tech and energy are playing a big part here, but 10 of the 11 sectors are likely to see positive growth. Healthcare is the only one that's not joining the party. What we're seeing is margin expansion at a rate equal to or better than any other period we've seen in our careers. And I can say that safely for all of us around the table. That's the big story. That's what's driving markets higher.
The story's great. It just depends how well priced it is right now. I know it's really, really early days, but it was touch and go just yesterday morning where it felt like the beats weren't really being rewarded, but the misses were being absolutely obliterated. Those stocks got punished. IBM a great example of that. Is that an early lesson, or is it too premature?
I don't think it's just about beats and misses. I think one of the things that's happening is that the nature of risk is changing. It used to be that it was a growth or a value story or a factor story. It's who are AI winners and losers right now. And you're funding your AI CapEx by not spending on mainframes. And I think as the market looks at that, they're asking, well, is this something that's going to continue for an extended period of time? Because you can't really start to ask if AI CapEx is going to peak until the hyperscalers stop raising capital to increase even more on the CapEx side. So when you look at things like the chip trade, I think they have room to go because the demand continues to outstrip. I also think that it's going to get more volatile because the first leg of this was earnings moving higher. You could see these chip stocks and you can see their earnings jumping. Now the question the market's wrestling with is, via long-term contracts and the sustainability of this play, should the multiple revalue? And anytime you're in a multiple revaluation story, it tends to be a little bit more volatile.
This has been an incredibly complicated year because it's both a micro story and a macro story. On the micro level, yesterday when we got the earnings reports, we did see pretty tremendous beats, and then we saw some of them with pretty paltry gains. Goldman Sachs is a perfect example. As the session grew older, those shares gained more and more. Yes, it was the commentary, but also it was this idea that disinflationary print on CPI would give the Fed more room not to hike rates. How much is this a rate hiking story as much as it is a micro story and a story of AI?
So if I were to rank them in priority order, I think the big story is earnings. That's really the underpinning of what's going on here. I think as it relates to the Fed, I agree with that survey. I think what you can misread from Chairman Warsh is I don't think he's actually being hawkish or pivoting in a hawkish direction. I think what we're doing is we're going back to a different kind of Fed guidance, and that is I'm going to be staunch in my defense of price stability in my comments, and I'm not going to tell you what I'm going to do. I remember being a young analyst on Wall Street once and hearing Greenspan speak, and he was about to do an interview, and he said, please don't ask me about monetary policy. I might be forced to launch a 30-minute answer where I tell you nothing. And I think that that's what you're going to see from Warsh today in front of the Senate. I think he's trying to break the market's dependency on being spoon-fed guidance, and I think that that can be misinterpreted by some as hawkish. I think what Wall Street is looking at is just as it would have been ridiculous to cut rates in the face of rising oil prices earlier this year, it's equally ridiculous to really be considering hiking rates until we see how all this plays out.
Putting aside Kevin Warsh and what his actual decision of what he's going to do is, it seems like the longer they remain on hold, the more the punch bowl is available to all the investors on Wall Street. The more you can get these earnings that continue to outperform in a massive way from the big banks. Why is that not how you see it, essentially?
Yeah, because I think when you look at the bulk of this earnings growth, it's not coming from rate-sensitive companies, right? It's not coming from smaller cap companies. Even the banks, while their numbers are good, and they were terrific and very good for the banks, they're not really driving the kind of 30% year-over-year growth. That's really coming from tech. That's really coming from places like material. That's really coming from places like industrials. The companies that are spending on chips have more money than the Lord himself. They don't need to borrow at the federal funds rate. And so I think that earnings growth is, in a lot of ways, at this point, really independent of rates. What you see, though, is that there's large swaths of the economy, middle-income Americans, lower-income Americans, smaller businesses, that do care about rates, and they've been under pressure for 3 or 4 years. And look, we can quibble about this, but the inflation rate's 2.6%, and the federal funds rate is 3.75%. those are real rates that are high relative to history, and I think they probably don't need to be there. We just need to get through some of this noise for that to become apparent.
Do you think it's that cohort that's being affected by those higher rates that's going to hold the Fed back from having a potential hike?
Yeah, look, I think that's right, because I think what you would do by hiking rates is punish those that are already being punished. You're not going to slow down AI CapEx spend, which is pushing up memory prices. You're not going to slow down the high-end consumer, where higher rates mean more money from their kind of money market account or their savings, and they all have fixed rate 30-year 3% mortgages. So I think it would be counterproductive, quite frankly.
Steve, you alluded to it. Do you think the multiple's going to go up?
So that's been the thing that I think we've gotten right over the last couple of years, is that if you're in an environment where margins are growing and the S&P is getting more profitable because of mix shift, because of more subscription-based models, then it's unreasonable to think that the multiple doesn't follow. And that's really been correct. If you look at where margins have gone, so too has the multiple followed. And until that stops, I think that's right. So what used to be a kind of 16 times, fair value, we think is somewhere right now between 20 and 22. That doesn't mean that that lasts forever, but until these margins stop going higher, there's really no reason to think that the market would pay less for a higher margin
investors
profile.
right now obsessed with potential downside. What I'm hearing from you is potential upside. What kind of upside are you thinking about?
So we're at 9,000 by the end of next year on the S&P. We think that that's, if you look at what that really represents, sounds like a big number.
Sounds like a massive number.
It does, but it's a year and a half of average equity returns. Kind of high single-digit, low double-digit returns. That's on average what the S&P does. But we think that that's the direction to travel. The CapEx continues to be there. The bottlenecks continue to be there. The pricing power continues to be there. This is the largest infrastructure build since the railroads. And the capacity that can come online that would derail these are hard assets. This isn't like a software upgrade. It's 3 to 5 years to build that chip capacity that then makes these prices go the other way. So we think that this has legs.
Steve, it's good to see you. Always is. Thank you, buddy. Steve Chiavarone there of Federated. NASDAQ futures this morning up by 0.5 on the S&P. We're positive as well. The earnings keep coming through. Speaking of big beats on Wall Street, BlackRock delivers another one.
As Steve is talking about how maybe we're underestimating how much the margins can keep increasing, take a look at this. The second quarter adjusted earnings per share for BlackRock, $13.91 versus the estimate of $12.66. This is a massive upside beat. Net inflows of $191.7 billion versus the estimate of $175 billion. When you take a look at the total assets under management at BlackRock, $15.3 trillion. I'm just trying to get my head around that number. It was expected to be below 15.2. The shares are up almost 2%, but it gives you a sense of the magnitude of beats that are coming out, surpassing already elevated expectations. Will it be the same for tech? ASML giving a sense of that. Nonetheless, you have to give credit to just how much this is blowing expectations out of the water.
BlackRock, the stock up by 1.7%, a series of upside surprises over the last 24 hours, and another one to start this morning. Let's give you an update on news elsewhere with your Bloomberg brief. Vonnie Quinn joins us for more. Hey, Vonnie.
Good morning, John. Fed Chair Kevin Warsh returning to Capitol Hill today after telling policymakers that slowing inflation in June doesn't mean the central bank has accomplished its mission.
The members of our committee have no tolerance for persistently elevated inflation, and we share a resolute commitment to ensure price stability.
Warsh testifying before the Senate Banking Committee this morning. ASML shares rising in European trading. The Dutch chipmaker lifting its annual sales forecast for the second time this year and laying out plans to increase production. The company saying a surge in AI spending is driving demand for its chip-making machines. In sports, Spain is headed to their first World Cup final since winning the tournament in 2010. They beat France 2-0 after the favourites only managed 3 shots on goal. Spain will meet either England or Argentina in Sunday's final. And that is your Bloomberg Brief. John.
Vonnie Quinn, thank you. Looking forward to later this afternoon. Up next on the programme, dropping the tax on Hormuz.
Saudi Arabia, UAE, Qatar, Bahrain, and Kuwait, they would love to invest more money in the United States at record amounts, and this way, there's no fee.
Up next, Anna Rosenberg of Amundi, live from New York City this morning. Good morning. Earnings season on Wall Street in full swing. 2 more to go. BNY at about 6:30 Eastern Time. Look out for numbers from them at 7:30 Eastern Time. We'll hear from Morgan Stanley. Looking forward to that over the next 60 minutes or so. Later this morning at 8:30, PPI data. And then after that, 90 minutes later, the Fed Chair, Kevin Walsh, testifying before the Senate Banking Committee. Looking forward to that. Equity futures right now into all of those risk events. Equity futures this morning positive by 0.2 on the Nasdaq 100, higher by 0.5. In the bond market, a bit of a reset following softer than expected CPI data yesterday. Twos back to about 420. They were pushing up to, say, 430. Yields are higher this morning by 2 basis points. 10's up a single basis point, still around 460. This is not a massive game changer. We talked about this yesterday. This maybe removes the urgency to hike, but does not settle the debate, especially with these numbers in the commodity market. Crude, WTI and Brent. Brent right now around 85, WTI Bramo around 80.
It is notable, though, to see that inflation expectations over the next 2 years keeps falling, even as oil prices start to climb once again. So, again, this goes to the question of credibility gap for both what we see at the Federal Reserve as well as just how quickly we can bring oil prices down. People seem to believe that this is temporary and that this is just yet another blip on the path to disinflation.
Crude this morning higher by 0.8%. Under surveillance this morning, dropping the tax on Hormuz.
I don't like the concept of a fee, but at the same time, it's not fair that we're protecting this strait for the entire world. Saudi Arabia, UAE, Qatar, Bahrain, and Kuwait, they would love to invest more money in the United States at record amounts, and this way, there's no fee.
So here's the latest this morning. The president reversing course on a charge for Hormuz cargo, vowing to escalate attacks on Iran and threatening the nation's energy infrastructure. With the latest, Tyler Kendall has more. Hey, Tyler.
Hey, John, good morning. Well, it feels like while President Trump is dropping one threat, he is expanding another, saying that the U.S. could hit Iranian power plants and bridges by next week if the country doesn't come to the negotiating table. But at this point, we've gotten very little indication that Iran is willing to back down, with the IRGC saying in a new statement on Iranian state TV overnight that the Strait of Hormuz will remain closed until further notice, and adding, in part, quote, the region's oil and gas exports are either available to all or available to none. Now, we know regional allies are urging for a solution. You heard President Trump outline there that he spoke directly with officials from these countries like Saudi Arabia, Qatar, the UAE, and Kuwait about dropping that 20% reimbursement fee in favor of trade and investment deals, though at this point it's unclear if there are any new commitments. What is clear, though, is that the U.S. is opting for that economic pressure to try to put the pressure on Iran when it comes to the Strait by renewing this U.S. naval blockade. Our analysts at Bloomberg Economics estimate that it costs the U.S. military between $31 and $45 million per day to keep that blockade intact. And, John, that is renewing the spotlight on U.S. resources and stockpiles, which President Trump is actually set to address today when he comes here to Pennsylvania for a speech focused solely on bolstering the U.S. defense industrial base, just made even more urgent amid this conflict with Iran.
Looking forward to your coverage. Tyler Kendall from the Defense Summit in Pennsylvania. Joining us now to discuss, Anna Rosenberg of Amundi. Anna, welcome to the program. We're obsessed and focused on one thing, and that's policy and changes to policy. Is this a new policy or not from the president?
The new policy to drop the tolls, I think that is a rather surprising development to the degree that the U.S. has benefited from free waterways, from the freedom of navigation, really, for the last 80 years. And to actually drop the principle and introducing a tax for the waterway would undermine that core U.S. principle. So it was never really realistic in the first place. So I was skeptical when I heard the plan in the first place. I am not surprised that he ended up dropping it.
Okay, but now he's saying that Gulf states will be making deals into the United States. Is he just trying to squeeze some of these rich economies to make more investments in the U.S., or will there actually be some sort of carrot and stick approach where you would actually see these deals materialize?
I mean, we know that this administration is very keen on getting more investments into the U.S., and we have heard about many deals and many investment promises in the past, but not all of these have materialized. And I think to this degree, The situation in the Strait of Hormuz is, of course, costing the global economy quite a lot, and the US is trying to guarantee its security. You can argue that this is not necessarily fair, but nevertheless, this is the situation it is. The US is a guarantor of global security to many countries, of its allies, etc. And ultimately, the US also started this escalation alongside Israel. So, of course, we may see some of the deals materialize, but many may not. And ultimately, you'll see other kinds of collaborations to try and get more ships passing through Hormuz. I think the Trump administration is hoping that its new campaign, its new military campaign, is weakening Iranian military abilities to the degree that they can help escort more ships through. But that is quite difficult at this point.
The president also said that potentially energy targets would be left for last. Do you take him at his word, or do you think this is a way potentially he could try to push the Iranians into either stopping going after some of these vessels or potentially back at the negotiating table?
So firstly, this is not just in Trump's control. We have seen forces unleashed that are outside anyone's control, really. Even in Iran, there are competing forces at place. You have, on the one hand, the RCG, which is much more ideologically motivated, and they think that the only way to get more resources in is to control the Strait of Hormuz. And then you have within Iran also those that are still interested in negotiating. So those are not on the same page. And if anything, the last week has made the IRCG argument much stronger. If you want to get any kind of income, you need to control the Strait of Hormuz because you don't trust the US in delivering on sanctions release and assets unfreezing, etc. So that argument is pretty strong. So there are forces out there that the US administration cannot control, firstly. Secondly, the Iranians still have the upper hand. They can attack regional oil and gas infrastructure and cause much bigger economic chaos right now. So we are in a situation where things have changed since the MOU was signed. The Trump administration is a little bit more confident that they can escort ships through the Omani route, but the Iranians have become a lot more hardline. So this entire situation is moving up the escalation ladder pretty fast.
Anna, why do you think the market hasn't really come around to this? Yes, on one hand, you've seen a creeping up of oil prices, but still below where they were just last month. And there's a sense among a lot of investors this is already passed in terms of the risk of the extreme $120 a barrel types of situations. Do you agree?
Well, to some degree, yes, because a lot of the oil has been rerouted already. And we have seen some still passing through Hormuz. So that has eased the pressure on the oil prices. And actually, the focus should probably be more on gas because rerouting is a little bit more difficult to that degree. And other critical things that are passing through the Strait of Hormuz, like helium, for example, as well. But in terms of oil price, we have seen successful rerouting. And as a result, this is emboldening Trump as well to be a little bit more aggressive and to take more risks because the oil price is what impacts the US voter the most. Gas prices is more something that concerns the European consumer that are obviously not as important for the midterm elections. So the oil price will likely go up if the Strait of Hormuz stays closed, but it's not what moves the needle here. It is the other things that are passing through Hormuz and have a bigger impact on other regions of the world.
Anna, it's good to hear from you. Anna Rosenberg there of Amundi. As we're having this conversation, some headlines dropping from US Central Command at 6 a.m. Eastern Time today. US Central Command forces began launching a wave of strikes against Iran. These strikes are designed to further degrade military capabilities Iranian forces have used to attack commercial shipping in the Strait of Hormuz. The latest from US Central Command. Crude off the back of those headlines, just a little bit higher, $80 on WTI. Brent crude around 86.
Well, the market was expecting this from everything we've heard from the president and other leaders in the administration. 6 a.m. Eastern, so just 25 minutes ago. That's 1:30 p.m. in Iran. Probably likely going after those assets that are along the coast.
Tension simmering across the Middle East. Coming up on the programme, we'll catch up with Stefan Slowinski of BNP Paribas as IBM suffers its worst one-day drop in nearly 60 years. Stocks are positive this morning, higher by 0.1% on the S&P 500, up by 1/3 on the Nasdaq. As Lisa mentioned, fantastic numbers out of BlackRock, stellar numbers across Wall Street over the last 24 hours. More still to come. BNY in a few minutes' time. In the next hour, we'll hear from Morgan Stanley. Looking forward to all of that with the bond market poised like this going into PPI later this morning. We've got yields higher by 2 or 3 basis points now, back to 422 on 2s, 10 still north of 460, 30 still around 5.1%. You haven't seen a massive change, even with softer than expected CPI data yesterday. The debate hasn't changed that much.
Well, ultimately, a lot of the softness and the first drop going back in 6 years really came from the idea that we've seen oil prices come down. If you've got oil prices rising once again and inputs like those related to artificial intelligence, how much comfort can you get? Mission not accomplished. Those were the words that really rang true to Wall Street yesterday.
Well, let's turn to crude and let's look at the price of energy together. WTI and Brent pushing higher by more than 1% this morning. Close to 86 on Brent, through 80 on WTI. Took a very small leg higher in the last 5 or 10 minutes off the back of these headlines from US Central Command that at 6 a.m. Eastern Time, so 30 minutes ago, US Central Command forces began launching another wave of strikes against Iran.
And CENTCOM is saying this is to further degrade military capabilities they've been using to attack commercial shipping in the Strait of Hormuz. We understand the kinetic warfare of all of this, what exactly the United States is going to be striking. The president even put energy targets potentially that could happen later this week. He said, or that would be the last we would go for. What is a little bit more unclear, and you've been talking about this, Jonathan, is what actually is the policy now? We went from a 20% reimbursement to the United States if you were able to traverse the strait, and now it's just invest in the United States and we'll have some deals.
Yeah, I don't think we've got much of a policy right now. And we talked about the new normal. The new normal at the moment is a messy set of negotiations, some unworkable proposals. That defines the last 24 hours, punctuated by a series of strikes, more strikes again this morning, and it keeps energy prices elevated. And that's the story in the energy market. As we count you down to the opening bell, 3 hours away, let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. We start with PayPal. Shares are soaring nearly 19% in the pre-market on takeover reports. Reuters is reporting that another fintech, Stripe, and a private equity firm, Advent, have made a roughly $53 billion deal for the company, which they will jointly own if the deal goes through. It comes as PayPal, the original fintech darling, has been struggling to turn around its business as new entrants enter the field. Meanwhile, we are seeing SK Hynix ADRs falling 6.7%, giving back some of yesterday's massive gains. The stock closed the day up about 27%. And what's notable is that at that point, the ADRs traded more than 50% above the Korean share price, an unusually wide gap. And the reason is because of strong investor demand here in the U.S., plus temporary restrictions that have prevented arbitrage traders from closing that gap. And we end on Lucid. Shares are sinking another 4.4% after a roller coaster session yesterday. That's because the company had to come out and clarify that it was working with restructuring advisors to turn around the business, not because it was considering bankruptcy. It called those claims completely false, but not before shares plunged as much as 57%, its worst intraday drop on record. John.
Yahara, thank you. Thanks for the update. More earnings still to come. Morgan Stanley in the next hour. BlackRock. Lisa went through the BlackRock numbers. Just fantastic results across Wall Street. BNY just dropping just moments ago. It's back-to-back quarterly revenue records for BNY. Lisa, one number that catches my eye. Assets under custody and or administration, 62.6 trillion. That is more than the estimate, and that is a record for this company.
Yeah, and it's versus the estimate of $61.3 trillion. I'm losing conception of the numbers here that we're talking about, but BNY is one of the biggest asset management companies and custody holders. Interesting to see that, again, they beat across the board with respect to net interest margin at 1.45% versus the estimate of 1.4%. Net interest income also beating. You just have to wonder how much people are already seeing these and then expecting even more. I am curious to see how the shares respond. Nonetheless, across the board, beat. That's what we've seen all of this quarter.
The stock is up by 1.2% so far this morning. On the session, on the year, it's higher by more than 30%. Later this morning, around 8:15 Eastern Time, we'll catch up with the CFO, Dermot McDonogh, on the latest results. But Bramo, to your point, The weather's been fantastic. The backdrop is great. And execution across a number of banks in the last 24 hours appears to be tremendous.
Yeah, you can see that people are looking for things to worry about. And even the CFO of JP Morgan said, you know, look, of course we're going to look for things to worry about, but maybe we should also worry about being too worried, because ultimately we've seen these upside beats after upside beats. You know, people are trying to wring their hands and find holes in the story of capital markets prowess. They can't find them just yet.
This is all I can find. Jamie Dimon, it's getting as close as it is to as good as it gets, maybe, right? Like, that's the question right now on Wall Street. Is that it? Can it get any better than what we've just seen at some of these banks?
And then he goes on to say, we just don't know how long it's going to last, because nobody knows. So this is the place that we're all left in. Can this really remain the case for a long period of time?
That's as bad as it gets this morning. Is this as good as it gets? Things are pretty decent right now. BNY higher by 1.2%. Looking forward to catching up with the CFO later this morning. Morgan Stanley, those numbers drop in about an hour from now. On our radar this morning, President Donald Trump pledging to escalate attacks on Iran.
We're going to hit him very hard tonight. We're going to hit him very hard tomorrow night. We're going to hit him very hard the night after. And then next week it gets really bad for them, because next week comes the power plants. Next week comes the bridges.
The US launching a fifth day of strikes on Iranian targets this morning after resuming the naval blockade in the Strait of Hormuz. Elsewhere, Fed Chair Kevin Warsh saying cooling inflation data doesn't mean it's time to declare victory.
There might be some that look at this morning's data and say, oh, mission accomplished, everything is swell. That is not my view. The Federal Reserve can and will deliver price stability. We have the tools to deliver that.
The Fed chair facing the Senate Banking Committee later on this morning. And finally, ASML boosting its sales forecast for the second time this year. Surging demand for AI chips pushing Europe's largest company to aggressively scale up machine capacity.
Yeah, ultimately, it all is about hardware. And that is a story, the ASML versus the IBM. IBM highlighting the concern among a lot of software companies that money is going to be diverted away from their services toward the hardware of the world. ASML's beat, though, just to give you a sense, net sales will grow between 43 billion euros and 45 billion euros. That's up from the 39 to 43 billion or 40 billion that was previously expected. So just incredible beats as people continue to hoard some of this hardware technology.
And of course, this all comes as their customers just continue to line up. They say that their customers continue to, quote, accelerate their capacity expansion plans. So for them, that means ASML was also having to expand their capacity, and yet they were able to do it.
And this is a theme already, and it's an expected one, and it's capex for the few, not for the many. There's a lot of spending, a lot of capital raising right now, but the beneficiaries of that are a small group of companies. IBM's a fantastic example of this, and we talked about this 30 minutes ago. The phrase they use, capex reprioritization. That's the issue right now for everybody else versus this handful of companies. Yes, there's a lot of money being spent, but only a few are receiving it.
It feels like it's a rolling ball of choke points, because on one hand, you see a prioritization of the hyperscalers and who has the best model. Then it was running to the large language models that could potentially disrupt them, the Anthropics, the OpenAIs. Then it was moving to the hardware and to the energy sector. Where is it going to go next? And that anxiety, I think, is underpinning some of the massive moves that we're seeing after these releases.
ASML this morning higher by close to 4% in European trading. Let's talk about IBM losing a quarter of its value in its biggest one-day loss going back decades. Stefan Slowinski of BNP Paribas keeping an underperform rating on the stock with a price target of 195, writing, we believe IBM was not a canary in the coal mine for software, but more of a capex casualty where its mainframe business suffered from capex crowd out. Stefan joins us now for more. Stefan, welcome to the programme. Do you believe that's a one-off or an ongoing durable story for the time being?
Yeah, good morning. I think that was the confusion yesterday around IBM. I think we can understand the CapEx crowd out justification, customers looking to spend on servers and memory ahead of even more price increases. But then IBM also did say that there were issues around cybersecurity. We assume that relates to the Mythos model from Anthropic and the Glasswing episode in Q2, where banks in particular, which are big customers for IBM, may have been distracted, may have prioritized more cybersecurity spending. And so that looks like it had an impact as well. And then IBM also called out execution, their own execution, which led to numerous deal slippages. So I think that caused a bit of confusion and nervousness. And as you point out, with the stock down 25% yesterday, there are a lot of nerves. And of course, even if there are justifications, investors also jump right to, is this something deeper around AI disruption? Is this finally the AI disruption of the mainframe coming? and you get those nerves coming through in the share price performances.
Stefan, even if you don't have some sort of bigger overriding existential thesis here, there is a question about the reprioritization and how long it will last. It isn't going away anytime soon, the investment in hardware and the investment in cybersecurity with new models coming out every single day. What's your sense of the timeline for when capital will get reprioritized back to the software names?
Yeah, that's the tricky question for this quarter in software. As you point out, we're spending on CapEx, we're spending on cybersecurity. When does it come back to maybe more traditional horizontal software? We saw the cybersecurity software stocks up mid-single digits, so they potentially are benefiting from this. We don't think this is the quarter that we see that reprioritization back to traditional platform software. We just published this morning our BNP Paribas global software reseller channel checks. They actually took a bit of a step back from April. The trend is still better than 24 and 25, but slightly weak. And I think that when you now have kind of a rekindling of the war in Iran, you're probably going to see companies continue to be cautious about the outlooks for Q3 and the rest of the year. So it's hard to see that reprioritization near term happening. And that's why investors are staying on the sideline for the most part for a lot of your traditional software stocks.
How much paralysis is there to get some of these bigger deals done just more broadly in the software space? Because a lot of companies are wondering, can we do this with our own staff, given some of the new advancements in large language models?
Yeah, so that continues to be a debate, which is the DIY AI, the do-it-yourself AI. Of course, you've had more recent discussion around pushback around token maxing, moving to token optimization, token capping, as we've discussed before. And so potentially some pushback on the OpenAI and the Anthropics and what they're charging. And so, you're seeing Microsoft, you're seeing Amazon, you're seeing some of the more traditional software and platform providers trying to step in and say, look, this is not something that you can just do yourself working directly with these models. That's complicated. There's lots of risks, right? We saw Satya Nadella over the weekend, with his essay around the risks of working with these AI models. We saw Demis Hassabis yesterday talking about the need for regulatory framework around AI. And so, all of that is certainly some of the big players in their own book and trying to push their customers back into their ecosystems to do this work.
Well, IBM was pushing the money elsewhere. CrowdStrike yesterday rallied by 12%. Closed at a record high, on the line out of IBM that customers were distracted by cybersecurity. Stefan, my issue with IBM yesterday, and my issue with a lot of companies when they report earnings, was trying to work out what's real, what's an excuse. Was that real? Is that what you see too?
In our survey we published this morning, cybersecurity was number one in terms of prioritizations last quarter, but it usually is. Most people usually say cybersecurity is our number one priority. So that's really the first that we've heard of this in the quarter. Again, it may be skewed for IBM because they are dealing with the banks. That's a big customer base, and that's where you probably had the most of those concerns. But we do think that certainly was an issue in Q2, will continue to be an issue, as you said. Today, we've highlighted companies like Microsoft, which is actually the largest cybersecurity company in the world, and also a ServiceNow, where they perform quite well in our results. In our survey, they just closed the Armis deal back in April. So they now have more of their own cyber and more security business. And they're starting to hit some easier comps in terms of U.S. federal, where last year you had the Doge effect and the government shutdown effect. And of course, those ease. So we do think cybersecurity is a durable growth driver for the pure plays, but also some of those other companies I just mentioned.
Stefan, it's good to see you. Thank you, sir. Stefan Slowinski there of BNP Paribas. Thank you. CrowdStrike don't report until the end of August, so we'll wait for those results to see just what happened last quarter.
Yeah, and whether it really is as a result of the big banks getting incredibly spooked by what they saw from Mythos. And just anecdotally talking to bank executives, there were weekly meetings with the top bank executives of the biggest banks for the first time since the financial crisis about this. I mean, it was really a major issue. So clearly there is something real. How much of this is also execution also is a key question.
Nasdaq futures this morning higher by 0.4%. Equities doing OK. Let's give you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. BNY reporting second quarter earnings that beat Wall Street estimates across the board, boosted by record sales and revenue. And coming up at 8:15 Eastern, we'll be speaking with BNY CFO Dermot McDonogh. BlackRock shares rising in the pre-market. Second quarter earnings beating estimates, with assets under management topping the $15 trillion mark. BlackRock also seeing record net inflows in the first half of the year. Bank of America releasing its fund manager survey for July, finding investor sentiment remains more bullish on a macro boom, AI capex, and they have dovish Fed expectations in the main. More than 80% of investors surveyed find going long global semiconductors is the world's most crowded trade. And that is your Bloomberg Brief. John.
I'm shocked. Bonnie, thank you. Appreciate the update. Seriously bullish one out of the fund manager survey from Bank of America this morning.
Nobody thinks there's going to be a recession. 2% of the people surveyed believe that there would be a hard landing, though most people on record believed that there was going to be no landing. Welcome to the recessionless nirvana that we're all living in, evidently.
It's crazy low, isn't it? Those expectations, just crazy. Up next on the program, mission not accomplished.
I reviewed the data on CPI, and I'm not going to show up here and say mission accomplished. The reason I create a task force on data is I don't want to overread or cherry pick data.
Up next, we'll catch up with Krishna Guha of Evercore, live from New York City. You're watching Bloomberg Surveillance. Stocks are doing okay. Busy morning already. Equity futures positive by 0.1% on the S&P 500. Very bullish fund manager survey out of Bank of America. More bullish on the so-called macro boom on the Nasdaq high this morning by 0.4. Let's talk about some earnings. Numbers out of BlackRock that started our morning. AUM, was it 15 trillion? Crazy numbers out of BlackRock this morning. The stock is up by 2.5%. BNY, more records there too. Back-to-back quarterly records for revenue, profit great as well. The outlook better. Beating a raise from them. They're looking for total revenue up by 10 to 11% for the year. They had seen it at about 5%. So again, Brammer, it's another morning of it, kind of like yesterday.
Just to give some perspective on the assets under management for BlackRock, 2 years ago, in the second quarter of 2024, the assets under management were $10.6 trillion. They have increased to Microsoft in that period of time in terms of their assets under management, about $5 trillion of assets added, just to give you a sense of the momentum underpinning some of these numbers.
BlackRock this morning higher by 2.5%. Need to turn to what's happening elsewhere in the energy market. Brent and WTI pushing a little bit higher so far this morning. This came from US Central Command earlier on, that at 6 a.m. today, so 50 minutes ago, US Central Command forces began launching a wave of strikes against Iran, another wave, and that's just this morning.
That's just this morning. The president said yesterday in an interview that we'll also have more strikes this evening, potentially, and then he even said it can go on to things like power plants and energy at some point. That'll be the last that get hit, maybe even bridges. So potentially more civilian infrastructure, which would be very controversial. CENTCOM just told us that at 6 o'clock they're doing this, but later today, hopefully we'll get a list of the targets.
Brent crude right now at 1%. The pressure still building on this Federal Reserve. Under surveillance this morning, mission not accomplished.
I reviewed the data on CPI, and it was positive relative to expectations. I'm not going to show up here and say mission accomplished. There's plenty of work to do. The reason I create a task force on data is I don't want to overread or cherry pick data.
So here's the latest this morning. The Fed chair, Kevin Warsh, preparing for a second day of testimony on Capitol Hill. Warsh vowing before Congress to curb inflation. Krishna Guha of Evercore writing, Warsh's comments plus June CPI make us more confident in our base case call that the Warsh Fed will narrowly avoid raising interest rates this year before cutting once next year. Krishna joins us now for more. Krishna, you're a very well-followed Fed watcher. What did you learn yesterday?
A few things. First, I thought Kevin Warsh was extremely accomplished and effective in dealing with Congress, reassured in particular on Fed independence, was not seen in any way as partisan. Second, I think it's what he didn't do. He didn't start to prepare the ground for a near-term rate hike, but he certainly didn't rule anything out as we look further out. Third, he drew attention back to the balance sheet, and I think that's a reminder that there's still a lot to come, not immediately, but a lot to come over time on the Fed balance sheet from Warsh.
Krishna, how much power do words have after a while if there is no action? And this is something increasingly people are asking as they are trying to glean whether or not there'll be a rate hike or just a rate hold, yet seem to have faith that they're going to bring inflation down.
Yeah, so I think Kevin Walsh has come out the gates making very strong statements about credibility, about the Fed's commitment to bringing inflation lower. Whether he has to then operationalize that by raising rates is a close call. My hunch is that he is at least putting some space between these two. Assert the credibility first, observe the inflation data over the summer, see if it's starting to move the right way. But I think if it's not, he's going to get called at the September meeting and we'll have to go through with a hike. We don't see that in our base case. Why? Because we think the inflation outlook is starting to turn, but it's very close. And I certainly don't think that you can rely on statements of credibility only without action if the data doesn't cooperate.
Even if he doesn't want to give guidance, we are hearing from the Fed's Williams, Cook, and Musalem today. We have continued to hear rosters of Fed officials speak. How do you understand their words? Are they as relevant? Are they more relevant? Are they less relevant?
I think the unfortunate reality is that when the Fed chair refuses to discuss his strategy in any detail at all, then that creates a void. And that void is inevitably filled by comments from other Fed officials. But there's a higher ratio of noise to signal because you can't be clear exactly who is speaking with authority for the committee. I don't think this is helpful. And I do hope that over time, Warsh will be willing to flesh out his strategy some more.
Krishna, yesterday he said his commitment and the entire committee's commitment is to take sticky prices and unstick them. How can he do that without a hike?
Yeah, that was not a phrase that I thought was particularly well unpacked, let's say. Look, I actually don't think that the US does have a sticky inflation problem right now. If it did, I would be calling for rate hikes. I think the reason inflation is continuing to run several clicks above 3% on core PCE is because you have 3 one-time waves rolling through on top of underlying inflation. That's tariffs, oil, and the peak AI capex cost spillovers. That's keeping inflation high. It's the very opposite of sticky inflation because, of course, these are different things, rolling in, peaking, rolling off. But let's take Warsh's formula. Suppose they are sticky. How do you unstick them? Well, I guess in theory, you could have some shock to expectations, reassurance about the Fed, so powerful that people no longer anticipate and factor in somewhat higher inflation. But as you indicated earlier, I think the idea that you can shock expectations to unstick sticky prices without moving rates and potentially, not just once by any means, I think that seems a bit far-fetched.
Krishna, it's good to catch up. As always, thank you, sir. Looking forward to day 2. Krishna Guha there of Evercore. It sounds more and more like an argument to hold rates and not hike. When they say that inflation is above target and we won't tolerate it, I guess at that point, it means we're not going to cut. Doesn't mean we're going to hike.
Right. Well, that's essentially what people are interpreting this as. At a certain point, though, you're not going to tolerate it, but it's been there.
Right, for 5 years.
For 5 years.
You have been tolerating it.
And you're continuing to tolerate it. So, again, lots of questions.
Looking forward to day 2. Are you? Yeah.
Oh, very much so.
In front of the Senate Banking Committee later this morning. That kicks off at 10 a.m. Eastern time.
Argentina versus England.
That kicks off a little bit later. Unfortunately.
You can make both.
If it was at the same time, I don't think there'd be much of a side-by-side there, Bram.
Exactly.
I think it would just be one screen. Kevin, of course.
Yeah, exactly.
Up next, Cam Dawson of NewEdge Wealth, General Robert Walsh of Academy Securities, Gerard Cassidy of RBC, Jill Ford of Wells Fargo.
We think inflation actually is coming down.
Overall, we don't have an underlying inflation problem.
This print does suggest that there's reason to believe that that cools down in the second half of the year.
The Fed should act with even more force in order to reinstate that level back to 2%.
I don't think that the Fed chair has a lot of power to limit the ability of people to talk about their outlook for monetary policy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action scores look like this. Equity futures on the S&P 500 firm up by about 0.1%, up by 0.5 on the Nasdaq 100. The earnings coming out already this morning. BlackRock, record AUM. BNY, record assets. under administration. BNY this morning down about 1%. BlackRock higher by 4.3%. The AUM, $15 trillion for the first time. Crazy numbers coming out of that bank. A little bit later, we'll be talking about PPI. That drops later this morning. Your bond market set up as follows. 2s, 10s and 30s. Yields still elevated in the bond market. Your 2-year at about 421. 10s at 460. When PPI drops at 830, that should set the stage for Chair Warsh, day 2 on Capitol Hill, going in front of the Senate Banking Committee.
Or will it? Because yesterday we got that CPI that came in weaker than expected, a bigger decline than expected, and he said mission not accomplished. Essentially, 1 month of data isn't going to change our view that we will not tolerate above 2% inflation. Of course, they have tolerated it, and they are going to continue tolerating it, considering the fact that July is not going to be a rate hike. Nonetheless, we are expecting to hear maybe some questioning that gets him to elaborate a little bit. I don't know. I wasn't that excited about these because I didn't think that anything would actually come out of them. And so far, I mean, essentially, there's a task force for what he's going to talk about.
Well, what did the heavy lifting for him yesterday was actually the softer CPI. And what helped CPI was, of course, that gasoline prices are down some 10% on the month. The issue potentially the Fed is going to have now going into the summer is that we have fresh strikes. Last night, the U.S. military ended at 10 p.m. Again this morning, 6 a.m., they started strikes again on Iran. All of this is going to continuously add to the geopolitical risk premium you're seeing in oil prices.
Well, let's talk about what the strikes were for. So this came from U.S. Central Command about 1 hour ago. They said the strikes are designed to further degrade military capabilities Iranian forces have used to attack commercial shipping in the Strait of Hormuz. This is the issue for me. Whether you pay for it, whether you invest in America or not, do we have the capability right now to help that energy flow through that strait?
Well, at the moment, what the IRGC has been able to prove is that they can go after some vessels that are going along the U.S.-supported protected route. Last night, when CENTCOM came out and said they finished some of their strikes, they went after things like fighter aircraft drones and naval vessels that launch precision munitions against Iranian missile and drone sites, naval capabilities, coastal defense system. So they are trying to degrade all of these assets Iran has at their hands that go after those vessels. How long is it going to take? We don't know.
You know, there's an interesting divergence right now. On one hand, you're having oil traverse through the Strait of Hormuz and traverse through pipelines that have been created. You're not seeing natural gas. Some of the refined products also getting hit much harder. If you take a look at diesel prices, they've continued to inflect a lot higher than, say, just gasoline or Brent. And you start to wonder, what about helium? What about these other assets? For gasoline, it seems like that is getting through, or at least for oil, that is getting through enough to ameliorate some of the bigger concerns that were present earlier this year.
Brent crude around 85 so far this morning. Coming up this hour, we'll catch up with Cam Dawson of NewEdge Wealth on the sky-high bar for earnings. We'll speak to General Robert Walsh of Academy Securities, warning that the war has reached its most dangerous phase yet. And finally, we'll speak to Gerard Cassidy of RBC as Morgan Stanley aims to cap off a record-shattering week for the big banks. Morgan Stanley reports in the next 30 minutes. We begin this out with stocks adding to gains following strong results from ASML, reigniting confidence in the AI trade. Cam Dawson of NewEdge Wealth writing, given high expectations, there is no room for error in 2Q26 results. Cam joins us now for more. Cameron, good morning.
Good morning.
What's the lesson of the last 24 hours with regards to these earnings stories?
Yeah, if you beat, you get rewarded maybe a little bit. If you miss, you get punished a lot. And I think that we'll continue to see that outsized punishment of misses simply because the bar is higher. We have to appreciate that 2Q earnings bar is so much higher than what we had in 1Q. 1Q, you went into the quarter expecting 9% growth and you got 29%. This quarter, we're going in expecting 23% growth. And importantly, you've seen that number for 2Q earnings move up through the quarter. Typically, you see estimates get cut through the quarter, but instead, estimates have gone from 18% to start 2Q and now sitting at 23%, which just means, again, you have this higher bar that companies will have to jump over, and if they don't, they will get outsized punished.
When I hear things like that, I think the right question is to say, typically I'd ask you, what do I want to own? Mm-hmm. Sounds like I need to ask you, what should I avoid this earnings season?
Yeah, I mean, it seems to be that you want to avoid places that have not had good earnings momentum, and you want to continue to be in places where there is potential for further upside. The challenge or further upside to earnings expectations, the challenge is you've raised forecasts so much for those areas. The SOX earnings forecasts for 2027 are up 72% this year. 72%. How much more upside is there to those estimates? And what we think is most important coming out of 2Q is not what happens in 2Q, but what does that mean for 26 and 27 estimates? 27 estimates and 26 estimates are up about 14%. That's why this market's been resilient. That's why we've been able to throw so much negative headlines at the market and have it continue to trend higher. So for this bull market to continue, we think we need to continue to see that uplift to 26 and 27.
One of the confusions has been how concentrated this has been completely in the AI trade versus a broader-based type of expansion. What we heard from the banks yesterday was that consumers are doing really well, that you're not seeing any deterioration. If anything, it's a reacceleration. Then you also are seeing the tech side of things, at least in the hardware, continue to outperform. Are both performing well, or is it more isolated to AI?
66% of the names in the S&P 500 are above their 50-day moving average. You have an advanced decline line, which is just a way to capture how many stocks are participating in the bull market versus not participating in the bull market. That's hitting new highs. So that suggests that it is not just an AI story. Now, because the gains and returns have been so powerful within AI infrastructure specifically, that has been the bulk of the earnings growth and the bulk of the upside surprise. But that does not mean that you're not seeing other areas of the market see earnings revisions move higher. You've seen about a 10% increase to earnings revisions for the equal weight S&P 500 this year. So again, it's not just the cap weighted index benefiting from these AI names, but you're starting to see it in the average stock as well.
So how do you explain Pepsi? Because Pepsi is sort of the outlier in all this. And John came back to me yesterday. They said, what about Pepsi? And it's cherry picking season. You could talk about Pepsi and the fact that consumers are pushing back and that they're much more discretionary when it comes to how much they're willing to spend. Which side of that story potentially is one to watch more?
Yeah, consumer discretionary and consumer staples are two sectors that have seen negative earnings revisions as we move through 2Q. But I think what's fascinating is that if you add up both of those sectors within the S&P 500, it's still smaller as a weight than the semiconductor industry group. So the industry group of semiconductors is a 19% weight in the S&P 500. You put staples and discretionary together, it's just 18%. So that's why this market is just so bifurcated, that yes, there is pain within the consumer because you still have elevated gasoline prices. They're still 80 cents higher than they were prior to the war. However, on a weighted basis, it doesn't matter as much as the absolute boom in earnings you're seeing within semiconductors.
How long is this going to last? Jamie Dimon's question yesterday.
Well, I think that is the ultimate question when we think about the semiconductor trade. It's not whether or not the earnings are strong today. Look at ASML. The earnings are incredibly powerful. It's how long it can last. And the thing about these businesses is that there's so much operating leverage in them. Earnings or overall revenue growth for semiconductors will be up 35% this year, but earnings will be up 135%. Last year, you had EBIT margins of 16% for the semiconductor group. Now they're going to be 44% this year. So yes, it's great when you have top-line revenue growth, but the warning story is that if you see top-line wobble even a little bit, you go from having incredibly power incremental margins to really painful decremental margins. So the question is whether or not you see a peak in revenue anytime soon and you see that deleveraging.
26 years ago, if we were doing the programme then together, we were all much younger, we'd be asking the question whether there was a bubble in price. 26 years later, Liz Ann Sanders at Charles Schwab is asking the question whether there is a bubble in earnings expectations.
Yeah.
Do you think there is?
Well, I think that the definition of bubble is really fascinating because what we see it as a pull forward of either price action or earnings power capacity, which means that right now you're seeing so much earnings growth within these semiconductor names that it's a question of how sustainable they will be. And I think the biggest challenge that you have is that the prices of the stocks will peak before the earnings. If you go back to that time in 2000 when we all were a lot younger, what you saw is that the prices peaked 12 months before earnings peaked. So you're going to have a 12-month period potentially of cognitive dissonance where the earnings are going to be incredibly powerful, but the prices will be flat to down. An understanding of whether or not you should be selling rips or buying dips is going to be the ultimate question as we move through that period. And I think that's where we have to use the technicals to be our guide. If we start seeing things like lower highs, unable to take out prior highs, that could be a sign that the market is thinking that we're nearing a peak.
I've got to ask you the impossible question then. Are we there right now? Do you see that in any way, shape or form?
I don't think that we can make that call yet. I think it is an innocent until proven guilty. If you look in the last 3.5 years, you've seen 6 corrections of 15% or more. And each of those corrections have been great buying opportunities because people have been underestimating the earnings power. Just look at 2026. Earnings estimates were 50% too low for the stocks at the start of this year. So it is very possible that you start to see some more churn. People start thinking that 27 is the peak, but the question is there any evidence that we're seeing that? I don't think that there is yet.
Cam, it's good to see you. Thank you. Cameron Dawson there of NewEdge Wealth on the earnings and the price of the earnings right now.
Yeah, you know, there's a question of who's going to pay for this, right? We talked about the transfer of wealth from the hyperscalers to the semiconductors. Well, the transfer of wealth has gone so far that people are starting to push back. Who is going to prove that they have enough return on investment from deploying some of these large language models to pay the high price versus, say, being cost constrained, which you're hearing on a lot of calls from earnings, particularly from companies in the banking sector.
Heard it from the banks yesterday,
exactly,
yeah.
JP Morgan.
Rationing use.
Exactly.
Don't use it for the easy stuff.
Yeah, just try to be mindful of exactly where you use and which models you use. And you hear this more and more, even cutbacks to their overall budgets because they're not necessarily able to cut staff or create other efficiencies elsewhere.
Humans are cheap, Bramo. There you go.
God, that makes me feel great.
Ask for a raise.
They are, yes, especially if you work in some of these industries. That's the reason why people are worried about expenses.
Sales and trading in the last quarter, without a doubt, right? I mean, come on.
They're feeling their worth right now.
Huge bonus coming at the end of the year.
I mean, that's the reason why also Richemont's doing so well.
Oh, because they're spending already.
Cartier.
Go into the watch store straight afterwards.
Actually, a lot of the jewelry in Cartier is doing very well.
Futures this morning up 1/10% on the S&P. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. U.S. Central Command saying it began a fifth day of strikes against Iran at 6 a.m. Eastern this morning. President Donald Trump saying the strikes will intensify until Iran agrees to open the Strait of Hormuz. Iran retaliating against the U.S. overnight, hitting bases in Gulf Arab states. OpenAI is developing its first device. Sources telling us here at Bloomberg it is a screenless, mobile smart speaker with integrated AI capabilities. Plans for the device have been complicated after Apple filed a lawsuit accusing the AI developer of stealing trade secrets. SpaceX shares are on the verge of falling below their IPO price. Shares of Elon Musk's company closing $1 above their $135 a share IPO price yesterday. The stock has plunged a third from its post-listing peak, erasing nearly $850 billion in value. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes. Up next on the programme, threatening escalation.
I'll save the energy targets for last, but ultimately we'll hit energy targets. Next week it gets really bad for them because next week comes the power plants, next week comes the bridges.
Up next, General Robert Walsh of Academy Securities, live from New York City this morning. Good morning. Futures positive by a tenth on the Nasdaq. We're up by about 0.5. In about 15 minutes' time, we'll hear from Morgan Stanley. The numbers so far, fantastic for the financials. BlackRock early this morning, record AUM north of $15 trillion over at Larry Fink's shop. Robin Vince of BNY doing well as well. Record quarterly revenue for a second consecutive quarter. The stock is down by about 0.75% on the session. It's higher by more than 30% on the year. We'll catch up with the CFO, Dermot McDonogh, a little bit later this morning, in about 60 minutes from now.
Yeah, just to give you a sense of how good the big bank earnings have been so far, total trading revenue generated by the six largest banks in 2019, or actually last year, was $13.5 billion. With Morgan Stanley, it's expected to surpass $25 billion so far. Just to give you a sense of how much they have expanded. And BNY is no stranger to that kind of dynamic, also expanding their assets under management. It truly has been a blockbuster quarter.
The numbers have been absolutely fantastic. More still to come. Morgan Stanley in about 15 minutes' time. Let's turn to crude. Energy this morning, Brent's higher by 0.9, 85 on Brent, WTI at 80. Under surveillance this morning, threatening escalation.
I'll save the energy targets for last, but ultimately we'll hit energy targets, yeah. But we're going to hit them very hard tonight. We're going to hit them very hard tomorrow night. We're going to hit them very hard the night after. And then next week it gets really bad for them because next week comes the power plants, next week comes the bridges.
So here's the latest this morning. U.S. Central Command saying the U.S. launched a fresh wave of strikes against Iran at 6 a.m. this morning. The president vowing to continue the attacks if Tehran doesn't come to the negotiating table. Bloomberg's Tyler Kendall has the latest. Hey, Tyler.
Hey, John. Well, CENTCOM confirmed that this latest wave of strikes launched within the last hour are focused on degrading Iran's ability to target commercial shipping amid very little indication that Iran is willing to back down at this point, as the IRGC said in a statement overnight to Iranian state TV that the Strait of Hormuz will remain closed for now. Now, we did get an update from the International Maritime Organization, a UN body that helps to oversee the traffic in the strait, speaking to our colleagues on Bloomberg Radio earlier today, saying that they have deemed the strait too dangerous to transit, including the fact that we have seen some of those ships that have turned their transponders off even be hit by Iran in recent days. Now, today marks the 5th straight day of U.S. attacks against Iranian assets as President Trump renews his threat to hit critical infrastructure if Iran doesn't come to the negotiating table by next week. He mentioned power plants and bridges, but as you heard, he said that the U.S. would save energy targets for last. What is clear is that the U.S. is trying to prioritize that economic pressure at the moment when it comes to reimposing that U.S. naval blockade, even if it moves forward without that plan for that 20% reimbursement fee. But John, our analysts at Bloomberg Economics estimate that it costs the U.S. military between $31 and $45 million per day to keep that blockade intact, which is raising questions about U.S. resources and stockpiles, which President Trump is expected to address in remarks later today here in Pennsylvania.
Tyler Kendall with the latest. Tyler, thank you. Appreciate it. And looking forward to your coverage later on today in Pennsylvania. The words of the president, next week, it gets really bad for them. General Robert Walsh of Academy Securities writing the conflict has entered a more dangerous phase than at any point since the initial outbreak earlier this year. This is becoming an economic contest as much as a military one. General Walsh joins us now for more. General, some people might be surprised by that statement, that this is worse than what we saw through March into April. For you, sir, what makes it worse?
Hey, good morning, John, and thanks for having me today. I think what makes it worse is we went into a period of negotiations where we thought there would be an agreement. We had a memorandum of understanding. The key pieces to that was the U.S. would stop the blockade, which we did, and Iran would open up the Straits of Hormuz, and that didn't happen. And Trump really was trying to get to negotiations, to get to a deal, and now that's all broken down, and you saw now that he's escalating the U.S. reaction to this, taking it to a much higher level. And I think that the challenge really right now, which makes it more risky, is that there really is no signs that the negotiation is going to start. He's going to put the economic pressure, as you see with the blockade restarting. The sanctions are now reinstituted, and now just much more military power going at strategic sites now to kind of open up, number one, open up the straits by not allowing Iran to hit commercial shipping. And the other one is to hit the ballistic missile sites that cause the ability of Iran to retaliate against U.S. bases in the region and also our Gulf state partners.
General, you heard the president, though, also talk about potentially going after civilian infrastructure, energy, bridges. Do you think that's a credible threat?
Annmarie, I think, sometimes when you get to this point, I mean, obviously we're trying to open up the Straits of Hormuz. That's the military tactical problem. But you also see that Iran is willing, the IRGC leaders are willing to take a lot of pain. So now you have to ratchet up, you have to escalate to bring more pain to them. And one of the ways to do that is start going after the infrastructure targets. Things like the president mentioned, bridges that are dual use, bridges that can supply the military bases. If you look at Iran's terrain, it's a lot of mountains and gorges. They have a lot of bridges that resupplies them. By cutting that off, it not only causes problems for their military, but it also causes problem for their infrastructure, civilian infrastructure, and it just starts to get so painful. The infrastructure grid and hitting their oil capacity at Cargill Island, which President Trump said he would hold off on for now, those are type of targets that he wants to get to the point where if there was a regime change, we would like to be able to go in there and help Iran rebuild and not have lots of massive damage caused by some of the attacks we would do. So I think he's starting there, ratcheting up this escalation, trying to bring pressure on the IRGC. And this right now is turning into an endurance campaign. This is now, can we, extend this, this campaign? How long can it go? The president just told Congress that he was going to extend this now for 60 more days, start that clock on July 10th. Iran would like to take this and extend it right through the midterms and cause the president lots of political problems. So I think that's the endurance situation we've got going on right now. Iran wanting to continue, Trump wanting to really put the pressure on them to bring them back to the negotiating tables, to negotiate in fairness, to open up the straits and have the discussions on the nuclear capabilities.
How would you characterize this moment we're in? Because it's certainly not a ceasefire, but the president will stop short from calling it all-out war.
It's certainly the continuing of the conflict. It's not in the same heightened phase where we were earlier in the first phase, that ended back on April 8th when we were hitting targets all across the country. This is now much more focused on, hitting the targets that would cause the straits to close or put risk on commercial shipping. So it's a very focused phase on the Straits of Hormuz. But now the president is starting to open that up a little bit more with this escalation of now being able to hit infrastructure targets, he said, starting next week. That would start taking it now from the phase of just focusing on the Straits of Hormuz and opening it up to more of a strategic campaign to bring pressure to the Iranian government by hitting some of those more strategic infrastructure targets.
General, how unified are the Iranian leaders, given the fact that it seems like the U.S. is struggling to negotiate with one voice? It seems like that was one of the sticking points, and the flipping and the flopping. In other words, can negotiations be a solution to this when it's unclear who the parties are doing the negotiating?
Yeah, Lisa, it's a great question. We're trying to really see how that is all playing out, but it's obviously the political leaders that are making these deals have no control really of what the IRGC is doing. So it almost seems to be the point you have to deal with the IRGC, because whenever you come to any type of agreement with the political or diplomatic negotiators, it unravels very, very quickly, and none of the negotiations have stayed intact. So I think the key thing here is now trying to bring pressure on the IRGC, taking away their power, their tools, the things they use to be the predator of the region that they've been so long, not only attacking the Gulf states, but also resupplying their proxies throughout the region. That's what's allowed them to be the predator. That allows them to intimidate and coerce other nations. That's what they want to do, and that's where they see the strategic capability of closing the straits now allows them to be even more of a predator in the region. And that's why I think the key thing now is to bring pressure on them to see if you can get that. This is going to be very difficult, and it's going to be hard to see whether, President Trump can do this in the 2 months, because he's got about 2 months, not only the 60 days he's told Congress, but he's probably got about 2 months till we start getting close to the midterms, and the IRGC knows that. So now it's how much will he ratchet it up, how much pain can he bring to them to see if he can bring them to the negotiating table.
General, we appreciate your insights, sir. As always, thank you. General Robert Walsh there of Academy Securities. Bramo, you nailed it, and that's what makes this so messy right now.
How do you get to a solution if negotiation's your ultimate goal, if there isn't a reliable person you're negotiating with? And we've heard reports about how one deal is struck, then the IRGC doesn't agree with it, then it gets revoked. People internally trying to struggle for power. It's a very difficult moment. How does this get resolved? There isn't an easy pathway in sight.
The attention turns to Wall Street. More earnings, this time from Morgan Stanley. So far this morning, BlackRock, record AUM, BNY, record revenue. Numbers from Morgan Stanley up next. So the story so far this morning for bank earnings. BlackRock, Wall Street, record AUM for them north of $15 trillion. BNY, record revenue. We saw this yesterday as well. JP Morgan, record revenue. Bank of America, record stock trading. Goldman Sachs smashing Wall Street records. So when you get to Morgan Stanley, you're not expecting anything different. This is what we got. Wealth management for the second quarter, net revenue $8.86 billion. The estimate, $8.68 billion. The beat, equity trading revenue, $6.3 billion, the estimate $4.47 billion. They smashed it too. The stock is higher by 1.5% on the session, on the year up by about 30%.
Yeah, so right now, all the trading volumes coming in well north of $25 billion for all the major banks, led by equities trading. All of that rotation under the surface, the paddling duck that Amy Wu Silverman of RBC talks about, has been a complete boon for the banks, particularly those that have been on the underwriting side of a lot of these IPOs and share sales in general. Morgan Stanley and Goldman Sachs together have generated some almost $14 billion of just equities trading revenue for this quarter. The number is absolutely shocking, record across the board.
Notable equity trading strength in Asia. Was that South Korea? No, I'm just guessing here.
The instability that will never stop giving. It seems like that would be a likely candidate.
I think it's the right kind of volatility for some of these businesses right now. What a backdrop for those particular firms. Beats across the board on Wall Street. That name, Morgan Stanley, just a little bit softer. But that was the story yesterday as well. A bit touch and go, that some of these beats weren't really rewarded in the way you'd expect them to be. But the gains we've had so far this year, the bar was already very, very high. Goldman did get rewarded later on the day, so we'll see if this move sticks this morning.
Yeah, Goldman had one of its best post-earnings trading days in years, up 9% at the end of the day. A question, though, a couple of questions that Ted Pick will be answering this morning, I'm sure. Provisions for credit losses actually came in a little bit above expectations, still below $100 million, so nothing to write home about. And fixed sales and trading, we had seen a couple of underperformances there at other banks, also coming in just a little bit light at $2.46 billion versus $2.56 billion. These numbers are massive, so it's not exactly as if, this is some sort of miss or loss. The forward look about the pipeline, is there the same kind of resilience and confidence that this could continue for a longer period of time?
I think it's fair to say that Ted Pick won't lose any sleep over that move this morning in the pre-market. We're down by about 0.1%. To your point on the pipeline, we heard this from Brian Moynihan at Bank of America. The pipelines remain strong. We heard this from David Solomon. Our backlog increased to its highest level in 5 years. So there's a lot more business still to execute for the year ahead.
Yeah, and that wasn't just Bank of America. Also, we heard that over at Goldman Sachs from David Solomon. Over at JP Morgan, a similar kind of tone. And that's the reason why even Jamie Dimon, who's looking for all of the potential risks on the horizon, saying we have no idea when they'll arrive. But it seems like this can't last forever. Nonetheless, right now, as far as they can see, things look pretty good.
Futures this morning positive by about 0.1 on the S&P 500. On the Nasdaq 100, higher by, let's call it, 0.5. Let's get you a wrap of the morning movers. Some single names. Yahira has more. Hey, Yahira.
Hi, John. Well, we'll stick with the financials because we are seeing BlackRock shares rising 4% after it delivered a blockbuster quarter. It attracted $192 billion in client assets, pushing its assets under management to $15 trillion for the first time ever. Earnings also beat expectations, helped by strong demand for ETFs, active strategies, and private markets. Meanwhile, just like we saw yesterday with some of the big banks and today with Morgan Stanley, banks are not necessarily getting rewarded for beating earnings. BNY shares are down nearly 1% in the pre-market despite posting a profit beat and record revenue. But the stock, like many of the others, had already been on a huge run. Just yesterday, it hit a record high, so expectations were clearly high for this name and have been for the rest of the financials. And we end on PayPal, those shares soaring 20% in the pre-market on takeover reports. Reuters reporting that Stripe, another fintech, and the private equity firm Advent have offered to buy the company in a $53 billion deal. If it closes, the two would own it jointly. It has been, as PayPal has been struggling as other fintechs enter the market and take over this, the darling, the original fintech. John?
Yahira, thank you. Stock is higher by 20%. Let's turn back to our top story on Wall Street. Wrapping up bank earnings, Morgan Stanley adding to a record-shattering week for the big financials. Gerard Cassidy of RBC joins us now for more. Gerard, welcome back. It's good to cover this stuff with you. Let's start with the good stuff. Let's start with equities trading revenue at $6.3 billion against an estimate of $4.5. Gerard, why has the backdrop been so good for that particular part of the business, not just at Morgan Stanley, but across Wall Street?
You're absolutely right, John. Across Wall Street, the trading revenues in equities has been extraordinarily strong. And there's a couple of factors there. First and foremost, the volatility in the markets, obviously coming out of February with the conflict in the Middle East and what has happened with the price of oil. That is one factor. But the other factor, too, and you guys have talked about it on the program, is the strength in the tech sector, especially linked to AI. And when you think about the semiconductor stocks, what they did in the second quarter in performance was extraordinary. And this all showed up in the equity trading numbers. Volatility is good for equity trading. And what we saw with the tech sector was another contributing factor why you're seeing such strong numbers.
Ted Pick, no doubt, can speak for himself a little bit later this morning on the call. But this is what we heard from Jamie Dimon of JP Morgan. It's getting as close to as good as it gets. Gerard, is it fair to say this might be as good as it gets for some of these names?
John, you're absolutely right. The numbers are very, very strong, and this is probably as good as it gets. We won't know for certain, of course. We'll look back 2 years from now, if you and I are chatting on the program 2 years from now, and we might say, my gosh, the SpaceX deal, the IPO was the top of the market for equities. We just don't know, but it is still strong. We're not expecting it to drop off, but seasonally it will slow down, of course, in the third quarter, but it's still a very robust market.
So how much can you take forward in terms of forward pricing, given the fact that we're seeing share buybacks across the board, dividend increases, and just, yes, maybe we'll see a bit of a deceleration. But just to throw this at you, the 5 biggest U.S. banks reported a combined $50 billion just from their trading revenues in 1 quarter. That's more than a third of all trading revenues last year from these banks. I mean, is that enough to get you excited about these names, even if there is a slight drop-off in acceleration?
Lisa, it's a very good point, and we have to look through the valuations relative to expectations. And you're right, the stocks have had very good moves, and they're trading at very rich valuations. Morgan Stanley's over 4 times tangible book value. Goldman and JP Morgan are over 3 times tangible book value. So you really have to expect for these stocks to really work going forward like they have in the past 18 months. You have to expect that these activity levels are going to continue, and that could be a big ask.
At this point, there seems to be a little bit of nervousness, and I stress a little bit of nervousness on the part of investors that there is an overbuild going on in the AI space, and that maybe they don't want to back anything and everything related to a data center, at least not without some pretty strict terms. Is there any sense of how much that could potentially crimp activity heading into the remainder of the year?
It's a good question, and I've been asking that question on the earnings calls that we had yesterday. We'll likely ask that question today. How do we frame out the impact that AI is having on not just the markets, but the economy? And I don't mean just the building of data centers, but the whole ecosystem of AI. How is it impacting? It's enormous. And I haven't received a good quantifiable number to say it's a third of the business or anything like that. But that we have to keep in mind, because we know it's a boom cycle for AI, and eventually it will slow down, not over the near term, but eventually it will, and will have an impact on the capital markets businesses.
Well, in just a moment, we'll be talking about the amount of equity supply, Gerard, that we've had in this market. Coming to market, Alphabet with a monster equity capital raise. We had one from SpaceX with a record IPO, SK Hynix, the biggest ever first-time issuer from a foreign company. All of that in the last month. Gerard, there is a question, still an open one, as to whether we will see the likes of OpenAI follow anytime soon, or whether we start to see some crowding out appear that would push these deals back a little bit. Gerard, what are your thoughts on that?
It's interesting, John, because if you look at the wealth of the United States, for example, back at the bottom of 08-09 during the financial crisis, this country's household wealth was about $61 trillion. Today, it's $183 trillion. The Fed's balance sheet back then was $700 billion. It peaked at $9 trillion at the peak of the pandemic. It's now about $6.5 trillion. There's enormous amounts of liquidity left over from the pandemic. And so we'll see. It's hard to really gauge whether there's a crowding out. It doesn't appear that way. The demand seems to be strong. And as long as the market's moving higher, I think that's going to continue to, the supply will continue to satisfy the demand.
And Joe, can I just say we will be here in 2 years. You'll be here in 2 years too, unless we're replaced by robots, and I hope that's not the case. Before you go, favourite pick until we next speak, next quarter when we cover all these names together, what's the favourite pick through the summer?
I think through the summer, Bank of America would be the pick to gear to.
Gerard, thank you. Gerard Cassidy there of RBC, with Bank of America remaining a favourite for him and the team over at RBC. Let's talk about some of these capital raises. They've been so oversubscribed. The amount of wealth in this country, clearly there's an opening, and we'll talk about it with Jill Ford in just a moment, for more still to come.
Yeah, and this is the reason why you've seen such incredible earnings, because not only is it the trading side, it's also the underwriting side, and the fact that there's a whole lot of market making that comes along with this. You asked a really important question. How much more is to come with the likes of OpenAI, with some real questions about the competition between OpenAI and Anthropic? And are people getting exhausted? You know, right now it doesn't seem like anyone's getting exhausted. It seems like they're just getting started. And based on these results, you know, some really good bonuses coming.
The numbers are crazy. What was that number for trading across 5 big names?
$50.53 billion from their trading units in the second quarter.
More than $10 billion than what was expected.
Yeah, correct. And it compares to $145 billion total for the entirety of 2025. That is more than a third. These numbers are absolutely astronomical. Record after record after record in every single unit. And that is what all of these CEOs keep talking about.
I saw a stat from the team here at Bloomberg that the equity business over at Goldman, Q2 was bigger than all of 2019. 1 quarter. Q2 bigger than all of 2019.
I saw that as well. It gives you a sense of just how big this beat was. They combined with fixed income and their equities trading made north of $13 billion, maybe $14 billion in terms of revenues. I mean, it's just incredible numbers. You start to see $15.3 trillion over at BlackRock, and you start to talk about real money.
This market, the bar will creep higher, right?
It's
and
true.
It starts to demand a repeat again and again, and that's the issue.
Yeah.
That's why we're asking the question, is this as good as it gets for some of these names?
And is that enough, right? If it's as good as it gets, if it lasts for a couple of years, it's just hard to feel really optimistic when you start getting surprised again and again and again to such upside, and you start wondering, you know, at some point the music's going to stop. It starts to make people feel uncomfortable.
Still playing right now. We're up by 1/10% on the S&P 500. What do they say? Keep dancing, right? Chuck Prince, something like that. All right. Let's give you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Morgan Stanley, as you've been saying, shares rising in the pre-market. The bank's second quarter earnings topping estimates. Trading revenue coming in well over expectations at $6.3 billion. The bank's assets across wealth and investment management topping the $10 trillion mark. New York issuing the first statewide moratorium on new hyperscale data centers.
I want to make sure that we take the time to have a community investment framework to give to localities. But also, you have to be able to power yourselves. You either bring your own power source or you have to pay a premium to use our grid. And those are the basic foundations of what we're doing with this moratorium.
Governor Kathy Hochul emphasizing the pause is, quote, not a ban. Americans may be keeping their clocks fixed on summertime. The House passing a bill that would make daylight savings time permanent. The bill now heads to the Senate. Even if it passes, states could opt out in favor of permanent standard time. That is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Up next on the programme, we'll talk to Jill Ford of Wells Fargo on why she believes this equity market is still wide open for supply. That conversation up next. Equity futures this morning positive by 1/10% on the S&P 500. On the Nasdaq, shaping up as follows, higher by 0.4%. Earnings from Wall Street's biggest names in the last 24 hours, printing record after record after record, and this morning no different. BlackRock with record AUM, BNY with record assets under administration, Morgan Stanley setting another quarterly record for stock traders. Morgan Stanley higher by 1.5%, reporting just 20 minutes ago.
Yeah, north of $6 billion for their equity trading revenues, also saying that they had records in each 3 of the geographic segments. Again, it's almost getting exhausting. Record, record, record. Who isn't having a record? At the same time, it really is the sustainability. And so far, we have seen ongoing resilience, at least in the commentary coming from the big banks. The pipeline is big, and there's a lot that still needs to get financed.
The backdrop is good right now. The weather's been absolutely fantastic.
Lovely.
The sun is shining brightly.
Sunny squalls.
So the only thing you can ask is, does it get any better than this, right? Peak bank. Peak bank was something that we spoke to Eric Najarian of UBS about earlier this week. Looking ahead to these earnings, is this as good as it gets?
Yeah, and are people going to get penalized for not necessarily highlighting just how much further it can go? Is it enough, though? If this is as good as it gets, but it keeps going for a while longer, that's enough. What? Keep dancing? So this is sort of the question that a lot of people have. it seems like CEOs don't have visibility into when it potentially will stop. So that's the one kind of silver lining for investors and the reason why you aren't seeing them being punished.
Morgan Stanley this morning higher by 1.3%. That's the story for the big banks. They've been leveraging this under surveillance this morning, sustaining AI spending. Here's the latest. Big tech racing to raise capital following Alphabet's monster equity capital raise, SpaceX's record IPO, and the biggest ever first-time issue from a foreign company from SK Hynix. Jill Ford, the co-head of equity capital markets at Wells Fargo, writing, markets are wide open. If you hit on the right theme, which is everything within what the market perceives as the golden halo of AI, that's where things land. Jill joins us now for more. Jill, good morning. Good to see you.
Good morning.
So I think you've got to an important point. Yes, the equity market's wide open, but is it wide open for only the companies that tick certain boxes?
Look, it's been an incredible first half of the year with respect to the equity capital markets. And as you rightly point out, the AI super cycle is taking hold. They're using all of the tools in the toolkit across the AI ecosystem, from the hyperscalers to the neoclouds to the semiconductor companies, all the way down to the real infrastructure, the data centers and the power behind that. But as they use all the tools in their toolkit, the equity capital markets are a meaningful part of that. So it's not just structured privates, it's not just the bond markets, but it's also the equity markets. And you're seeing it, obviously, what you just mentioned in terms of follow-ons and converts, but in the private markets and then ultimately in the IPOs as well.
We've seen some massive issuance from certain kind of companies, which is what I'm trying to dig into here. Software. Is the path available for those names too? IBM got hammered yesterday. Can you walk us through the kind of contagion effect, the chilling effect that might have for the potential for some companies like that to come to market?
Well, look, I will tell you that the flavor of the month, the flavor of let's call it the year, is AI. No question. All eyes are on that as it relates to tech. But there are definitely software companies sitting in the private realm who can and should be public. I'm thinking cybersecurity type names. I'm thinking those software companies that are owning the data horizontally and vertically. But there are also many who I think will have to sit it out and may, in fact, have to consolidate with others or not exist. If you look at some of the public mutual funds who have to mark their private positions, and as you know, those mutual funds have been investing in the private realm for some time now, they're marking those positions down 20% plus. So there is definitely a re-rating in valuation. There will be some that will be made obsolete by AI, and there are others that will have a tailwind and will be able to exist in this world, and those eventually will come public. But all eyes, make no mistake, right now within tech are on AI and everything within that ecosystem.
Those eyes are not indiscriminate, and they're not necessarily just buying blindly. And we saw that with Amazon. We've seen this with other issuances where there's been a little bit of pushback on the edges. At least that was on the debt side of things. We also have seen SK Hynix with an incredible amount of volatility in the ADRs and, frankly, in Korea as well. I just wonder if we're starting to see the beginning of a bit of pushback, if there is a little bit of supply indigestion that's coming down the pike as some of these other issues prepare to go to the market.
Well, look, I'll take your attention back to SpaceX. SpaceX was an incredible exhibit, reminder that the U.S. public markets are incredibly deep. For a deal that was 3 times the size of the largest IPO to ever come, and to have multiple times of oversubscription, to be able to garner demand from all corners of the world, all different types of investors with different lenses, and still be able to not only absorb that supply, but to keep on trucking in terms of additional supply that has come since and before, as you point out with Alphabet, is really a testament to the fact that there are deep pockets within active money management. And I don't think that we have exhausted the amount of that demand because people are making money. You talk about SK Hynix, it's been incredibly volatile, but people made money on that. And the average IPO cohort, if you look at right now, it's close to 15%. So I don't think the music stops because of supply. I think the music stops if we don't have the incredible backdrop that we're enjoying right now.
What would cause the incredible backdrop to be less incredible? I mean, is it something macro, or is it something where suddenly people realize who's going to pay the bill for all of these big hyperscalers and for these large language models that are being levered at pretty significant rates, even though a lot of companies are pulling back on their expenses or actually rationalizing their token use?
Look, I think we have a long way to go with respect to AI and figuring out where all the chips are going to fall. That being said, I still think we're on the precipice of changing the way the world does business, changing the way that we all live, and the capital formation that has to accompany that is incredible. Right now, what could derail things, I think, are more macro. We've got increased tensions in the Middle East. Right now, the market is shaking it off. The consumer still appears very healthy. If that changes, right now, inflation appears relatively under control. If that changes, all of those macro indications that, we can't be priced to perfection. Right now, we're priced to perfection because earnings have been great, because the backdrop has been relatively calm. The VIX is sitting at 16. If that were to change, particularly in the back half of the year where the calendar starts to shrink in terms of your windows to be able to go public, then you could start to see some around the edges, some marginal people putting off or perhaps a rationalization on valuation as well.
There's also a midterm election towards the end of the year. And
no question.
We saw yesterday this moratorium on AI data centers. Do you think policy potentially could have individuals thinking, I'm going to wait and want to see how all this shakes out?
I think investors are worried about it. And I think as we speak to issuers, many people want to get ahead of it because they don't want to have to be in that maelstrom of headlines and people wondering what that means. So I do think it's on people's minds, and we'll see what comes up.
So you think before the end of the year, more people are going to want to go maybe before that date in November?
I think so. What you're dealing with, though, is, you'll have the August doldrums. The Labor Day is a week later than usual. Then you've got the Jewish holidays. Then you've got Thanksgiving. You've got the midterms. You've got Christmas. I also think investors may close their books early because they've done so well. They won't want to risk it going into year end. So there's a lot that's going on the technical side of it that maybe people want to accelerate their plans and come earlier in the last quarter versus what they normally would. And then many may wait until 27 and things calm down.
I'm right there with them. Shut it down. Take the year off.
I was going to say.
You're right there too.
I was just going to say, is it too soon to close the books
Joe's had a great
right now?
year already. Just shut it down.
Exactly.
Long vacation.
We're just getting
the rest
started.
of the year. Oh, yeah.
Jill Ford of Wells Fargo. Jill, thank you. Appreciate
very
it.
much.
Just getting more details of another round of strikes across the Middle East, across Iran from U.S. Central Command. Those details drop in just moments ago.
Right, so they wrapped up the latest strikes, the morning round this morning at 7:30 a.m. Eastern. And CENTCOM is saying that the U.S. launched precision munitions against coastal defense systems, cruise missile storage, launch sites, basically going after anything that Iran has in capability to attack vessels that are trying to transit the Strait of Hormuz.
It's keeping crude elevated. It's not adding to the rally. Crude this morning higher by about 0.1%, 79 on WTI. Brent crude around 85. If you turn to the bond market, yields have been higher throughout much of this morning, up by a couple of basis points, up by 2 on 2s to 421, on 10s just north of 460. The next stop for that bond market, not just energy, but PPI data. That data drops in about 35 minutes' time. Up next on the programme, we'll catch up with Ed Yardeni of Yardeni Research. We'll speak to the BNY CFO, Dermot McDonogh. We'll catch up with Stanley of Santander, plus the former US Commerce Secretary, Gina Raimondo. All of that in the third hour of Bloomberg Surveillance, just around the corner.
The power of earnings is too strong.
Earnings revisions breadth is still surging.
At some point, valuations will become an issue for investors.
We've been warning our investors that a correction was coming across the board.
It's premature to get too worked up or too bearish.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores, the price action looks like this. Equities higher by 0.1% on the S&P, on the Nasdaq up by 0.4%. The bank earnings roll in. Earnings season completed on Wall Street. There we go. In just 24 hours. Not bad, eh? BlackRock this morning, record AUM. That stock is up by 4%. BNY, record assets under administration. That stock is down 1% this morning, up on the year by more than 30. Morgan Stanley also higher on the year, around 30%. Morgan Stanley this morning up by 1.8%. Another record, this time again, for the stock traders over at Morgan Stanley. We've seen that on repeat over the last day.
And they're not small beats. These are massive beats. And you can see that the collective beat across Wall Street is up by some $10 billion just in the trading revenues overall when you combine the top 5 banks. Question is, how good is it going to get? Can this be something that can be repeated again and again? And how big is the pipeline going forward? So far, the commentary is the visibility that we have is all systems to go into the end of the year. For people who want to be nervous, that kind of positivity makes them nervous. You see this in the Bank of America Fund Manager Survey as well. Nonetheless, the data seems to be backing it up and at least disinflating enough to keep it on the rails.
You said this earlier this morning, I'm right there with you. It was a bit touch and go yesterday morning, where these beats weren't really being rewarded and the misses were getting massively punished. And that changed at about 8:30, when CPI came in a bit softer than expected. Rate hike expectations, at least in the immediate term, the very near term around July, start to soften up a little bit. It allowed the equity market just to go a little bit more. I don't think we would have had the moves we had by the end of the day without that happening at 8:30 Eastern Time.
I couldn't agree with you more. This is both a micro story and a macro story. The micro story has to do with AI, although that's turning into a macro story, and how much it's fueling some of the capital markets activity. On the macro, the Fed needs to not get in the way for a lot of these multiples to sustain themselves. And that's what a lot of people have been saying. If the Fed takes away the punch bowl, and they can if they hike enough, then potentially that brings the end to the party. Right now, it seems like the CPI report we got yesterday does not create urgency to raise rates in any material way in the near term, thus allowing the party to keep going and allowing people to get enthusiastic.
Twos this morning up 2 basis points. The next stop for that debate is PPI in 27 minutes' time. Your 2-year at 421, 10's up 2 to 461. Off the back of this move in crude. Crude still elevated this morning, up about 0.5%, around 80 on WTI. Brent crude around 85. As US Central Command indicates, they've wrapped up another round of strikes.
Right, 90-minute wave of strikes this morning, and we're getting a little bit more details on what actually the U.S. forces were targeting. They were going after coastal defense systems that the Iranians have, cruise missile storage, launch sites. All of this is to try to degrade Iran's capability to go after commercial vessels in the Strait of Hormuz. I was very impressed with what General Walsh said this last hour. And he made the point that when it comes to Iran, the objective is disruption, not necessarily denial. If it's only disruption, there's only a little bit amount the IRGC needs to do to disrupt waterways and stop vessels and having them second guess if they should go through, which is why the United States, it might take a lot longer to go after a lot of these sites and almost scare them back from doing even a little bit amount of disruption.
It doesn't cost them much to do it either.
Nope.
It's part of the problem. Coming up this hour, we'll catch up with Ed Yardeni of Yardeni Research on reduced urgency to hike interest rates. We'll catch up with the BNY CFO, Dermot McDonogh, as Wall Street crushes estimates, and the former US Commerce Secretary, Gina Raimondo, on what's ahead for the American AI build-out. We begin this hour with stocks little changed as investors count down to fresh inflation data and day 2 of Fed Chair Kevin Warsh's testimony on Capitol Hill. Ed Yardeni of Yardeni Research writing the Fed Chair's core message was that the Fed must stay focused on inflation while recognising AI's potential to support stronger, less inflationary growth. In other words, he endorsed our roaring 2020s narrative. Ed joins us now for more. Ed, welcome. To get your roaring 2020s, and we're more than halfway through at this point, do you need this Fed to stay on hold?
Yeah, well, this is actually the 7th year of the roaring 2020. So if we make it through this one, I think we got 3 more years, and then we can look back and say that turned out to be an amazing decade, and then we can start talking about the roaring 2030s. But I'm very pleased to see that Fed Chair Kevin Warsh shares our optimism about the outlook for technology-driven productivity. And that may explain why we're getting lower than expected inflation, because unit labor costs, which is hourly compensation offset by productivity, that's only up 0.5% on a year-over-year basis during the first quarter. And it does correlate with the CPI, and the CPI came in, as you all said, remarkably cool.
Ed, I'm pleased you've got visibility into the 30s, because I can't see beyond next week, at this point anyway. Let's talk about the here and now. The positive earnings shock that we witnessed at the start of the year that took a lot of people by surprise. How well priced is that positive earnings shock now?
Well, that's really the issue for the next few weeks, is we're now in the second quarter earnings season. And the problem is that the market may already be discounting remarkably strong earnings. As a matter of fact, on a year-over-year basis, analysts are predicting something like 20 to 25% increase in second quarter earnings on a year-over-year basis. So how much better could it possibly be? And So the answer, I think, if it turns out that the answer is that they're only as great as everybody expected, you might have some profit taking, but then watch the dip buyers come right back in. We see that over and over again because the reality is the earnings prospect remains very positive. Second, third, and fourth quarters, analysts are looking for 20 to 25% increases in earnings.
It seems like, Ed, a lot of how long this can continue really does hinge on the inflationary backdrop and the policy response to it. Something we saw yesterday, a disinflationary print really did unleash an even bigger rally in equities. I'm just wondering how much you actually took from yesterday's CPI print. Max Kettner of HSBC just came out and said the downside surprise was pretty broad-based and they think is the first sign of U.S. exceptionalism unwinding, unlocking lower yields. Do you agree with that?
I do, actually. Going into the CPI numbers, we thought that we did expect the pivot from easing back in April to tightening in June. We also thought that there was a rate hike possibility in July at the end of this month. And now I think the CPI took that right off the table. Interestingly, the 2-year and the 10-year Treasuries are still anticipating that nonetheless there will be at least one, if not two, rate increases over the next 6 to 12 months, and that's still possible. I mean, we still have the war is not over. We still have potential upside in oil prices, though that's also been a remarkable surprise. And then we've got the AI situation that, at least in the short term, is turning out to be inflationary. But all in all, you have to say that there may be some real magic here in productivity.
Are you nervous that people are so optimistic, including yourself? And I know I sound like the ultimate bear looking for something to be bearish about, but I'm looking right now at these surveys that show that just 2% of people in the Bank of America Fund Manager Survey see a hard landing as possible in the near future. Does that give you pause?
Yeah, I do tend to have a contrary streak, but I don't go contrary unless, the fundamentals really suggest to me that the crowd is missing something here. And look, I'm not dismissing the possibility of a significant pullback. We had one during March when the war was red hot. We could have another pullback in the current earnings season if suddenly one of the hyperscalers says, you know what, we're finding it difficult to build the data centers. Maybe we've got more capacity than we need. I mean, all those things are possible. And so there's still a lot of nervousness about the whole AI situation for sure. Obviously, less nervousness about inflation, less nervousness about what the Fed's going to do. But between the ongoing war in the Middle East, the potential for higher oil prices, the fact that inflation isn't back down to 2%, and Warsh has pledged that he will get it down to 2%. The question is, will he actually have to raise interest rates to do that, or will productivity do the job for him? So I think everybody knows the bear case, and it wouldn't take much to bring it to the fore. But I'm going to stick with a story we've been telling since the beginning of the decade, and that is that the economy is resilient and the consumer is resilient, and therefore earnings are resilient.
Ed, you're dubbing this phase of the conflict as Iran War 2.0. What does the market need to know about this version and place where we are with the conflict versus when it first started?
Well, this version seems to be more focused on trying to get Iran to finally give in. The problem with Iran is it's not clear who's in charge. There seems to be some sort of government, but there's also the Revolutionary Guards, and the end of the recent ceasefire seemed to have been triggered by the Revolutionary Guards kind of unilaterally disagreeing with the government, saying we're not on board here with any peace treaty whatsoever, any understanding whatsoever. So I think right now the war situation is really kind of focused on once again shutting down the ports of Iran in order to really immiserate their economy. The problem is the Revolutionary Guards don't care if their people suffer. So it could be a protracted situation where the United States really does have to provide military escorts to get ships out. But meanwhile, everybody's scrambling to find other sources of oil, to get oil distributed through other means. And it seems to be working. And in addition to that, it looks like China's economy is fundamentally weak, and that's depressing their demand for oil. So the oil market just has actually been far less troublesome than widely anticipated.
GDP a bit weaker out of China than expected a little bit earlier. Ed, final question before we go. You coined the phrase, bond vigilantes. Did they stay on vacation through the summer?
Seems so. I've been thinking that the bond yield is pretty much where it should be. We're back to normal in the bond market. I think normal is about 4.5%, plus minus maybe 50 basis points, so a range of 4 to 5%. I don't think is a problem for the economy. Quite the opposite. I think it's a signal that the economy is back to its old shape, that it can not only handle these rates, but can do business quite readily at these rates.
Close to the middle of that range this morning. Ed, good to catch up. Good to see you. Ed Yardeni there of Yardeni Research. Thank you, sir. Yields up by 2 basis points. 461. We're doing OK in the equity market off the back of this. Looking ahead to PPI data in about 20 minutes' time. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thanks. U.S. Central Command saying it began a 5th day of strikes against Iran at 6 a.m. Eastern this morning, and those strikes lasted for 90 minutes. President Donald Trump saying the strikes will intensify until Iran agrees to open the Strait of Hormuz. Iran had been retaliating against the U.S., hitting bases in Gulf Arab states. NVIDIA CEO Jensen Huang saying the company's next-gen AI accelerator systems are on track, following reports that the rollout could be delayed due to manufacturing issues. Huang said Vera Rubin is already in production and on pace for giant production volumes. The fossilized skeleton of a Tyrannosaurus Rex sold for a record $50 million at a Sotheby's auction. The T-Rex, named Gus, is described as one of the largest and most complete dinosaur skeletons ever recovered. The buyer unknown at this point. And that is your Bloomberg Brief. John.
There's one guy I thought of. Funny, thank you.
Me too.
Kenny G.
He already did it.
Well, we don't know if it's him this time, but because he already did it.
Maybe he's building a collection, which, to be honest, is so cool.
How cool would that? 8-year-old dream, right?
I was I mean, it's a dream
now. If you asked an 8-year-old kid,
it's a dream now.
If I gave you $1 billion, what would you do? They'd be like, buy dinosaurs.
Absolutely, and then recreate Jurassic Park.
Yes.
For the record, I've got no idea if it's Ken or not, but
but there we go.
People are wondering. Up next, the Morning Calls Plus, we'll catch up with the BNY CFO, Dermot McDonogh, as America's oldest bank delivers another record quarter. That conversation up next.
Across Wall Street, the trading revenues in equities has been extraordinarily strong. The numbers are very, very strong, and this is probably as good as it gets. So you really have to expect for these stocks to really work going forward like they have in the past 18 months, and that could be a big ask.
That was Gerard Cassidy of RBC weighing in on the financials a little bit earlier this morning. Equity futures at the moment up by 1/10, on the Nasdaq up by 1/3. That's the price action. Let's get you some morning calls. The big banks in focus. First up, Morgan Stanley raising its price target on JP Morgan, citing better than expected guidance for net interest income. Your second call from Barclays raising its price target on Goldman, highlighting better than expected trading and investment banking fees. And finally, Wells Fargo raising its price target on B of A, citing strong underlying financial trends. That stock is up again this morning. We're higher by 0.5%. Let's stick with our top story. Wall Street delivering a blowout earnings season. America's oldest bank, BNY, adding to those results, posting back-to-back quarters of record revenue and sales. Joining us now to discuss is the BNY CFO, Dermot McDonogh. Dermot, welcome to the program, buddy. It's good to see you. Record performance in Q1, again in Q2. What's behind the activity, Dermot? And the question I think that applies to your bank and so many others this morning is, can this continue?
Thanks for having me, Jonathan, and great to be with you. When I was getting ready for the show this morning, I wasn't too sure whether to put the tie on or put the England shirt on. So I put the tie on, but hopefully you'll bring it home today and enjoy the match this afternoon. Listen, BNY today, great results. We're really pleased with the performance. We feel like the firm is humming at the moment. We've built the company for durability and to take advantage of opportunities like this that the market has presented over the last quarter. The US economy is strong. We continue to be positive on the US economy. There's a lot to be optimistic about in terms of what's happening. Full employment, the yield curve is behaving well, flows are strong. And when you have a company like ours who has built a broad set of durable businesses and has been in this for a long time, with 20% of the world's investable assets flowing through your pipes every day, this shows up in kind of record net revenues, which we're just posting this morning, of $5.7 billion. So as a company, we're very pleased, but we feel like we've more white space to go and more opportunity, and we're going to keep pushing on into the second half of the year. And
Dermot, record assets under custody as well, north of 60 trillion. That's a record for the firm as well. You talked about it, you just alluded to it there. Help us draw a distinction between the backdrop and execution, the environment, and how the bank actually performed. What's happening there?
So look, we started on this journey 4 years ago, and I can say confidently under Robin's leadership that BNY today is a materially different company than it was a few short years ago. And I'll give you a couple of examples of that. We will talk this morning about this being our 14th quarter of consecutive year-on-year sales growth. This year alone, first half, we've had 2 record sales quarters. Our mandates are growing in size. 10% of our sales this year have been with new logos. So that points to the fact that clients are seeing what we're doing. They see the reimagination of the firm. They want to partner with us more in many different ways, and that's showing up in the numbers.
One thing that we saw, Dermot, was a sense of a real upgrade in terms of full-year revenue guidance that you put, up about 10 to 11% year over year versus the 5% previously. What gives you confidence heading into the second half that the momentum can continue to the degree that we saw earlier this year?
So look, I live and breathe BNY. I see the 47,000 people around the world working together as one, delivering for clients. And that results in strong pipeline, strong backlog. We're a better firm today than we were a year ago. And so, look, I think 4 years ago, if we had this backdrop that we're experiencing over the last quarter, we wouldn't have performed as well as we have this quarter. So we're making that 1% better, the firm, every day. And that compounded over a long period of time is going to give us the confidence that we can deliver for our shareholders, for our clients, and for our employees over a long period of time. So we're very bullish at the US economy. We're very bullish BNY and our strategy. We feel like it's working, and we kind of feel like that we have a lot of opportunity ahead of us. There's no shortage of work to do to make this company better.
Dermot, one thing that we've seen pretty much across all the banks is that expenses came in heavier than a lot of people had expected. I wonder how much of this is structural, that there is a sense that everything is getting more expensive, whether it's the personnel that potentially can drive the change in the performance, as well as some of the technological advancements that you need to be investing in.
So look, I obsess about expenses every day, as you would imagine me to do. The expense growth that we've seen this quarter, and we updated our guide for the full year to 6 to 7%, it's largely revenue-related plus investments. Over the last 3 years, we've roughly invested about $500 million in the firm in strategic growth initiatives, and that's largely been offset by our efficiency and transition to the platform operating model. So you can see that the investments that we've made over the last 3 years, you see that proof in today's results. And we're going to continue to invest in a thoughtful and prudent manner, and that will deliver durable results over the long term. I'll say this on the call today. We've developed new products, whether it's buy-side trading, Collateral One, Borrow Plus, products that weren't that meaningful to the overall revenue pie a couple of years ago are now delivering meaningful contributions to the revenue mix. So BNY is innovating as well and partnering with clients and stitching the firm together to deliver integrated solutions that we believe will allow us to grow revenue in the future.
I think, to be fair to you, Dermot, 10 consecutive quarters of positive operating leverage speaks to some of the things you just said there, that balance between cost discipline and investment. When it comes to investment, the focus right now is firmly on AI. Some companies seem to be rationing spending right now, Dermot. What comes out in the release from you and the team this morning is that your spend and the investment you've made on AI is translating into real business impact. Can you share with us where specifically and how this is trending?
So look, we talked a lot about, and we had a slide in our disclosure in Q1 about what we're doing on AI. Like in the context of BNY and a $4 billion engineering budget, our investment in AI is modest in the context of the overall budget. We've got a good strategy at BNY. We're very proud of it. We've been at it right since the start, since the launch of ChatGPT, and we're very proud of the platform that we've built, ELIZA. It's LLM agnostic, and so we feel like we have the right structure in place. We've had broad adoption with our people around the firm. We've upskilled people. Pretty much 100% of people at BNY now know how to use AI and are doing it in their daily work. And we think about enterprise productivity and individual productivity. And Robin says this lots of times, AI for everyone, for everywhere, for everything. And it's all about creating capacity and productivity so that we can allow the firm to grow and use AI to enable that. So we're AI optimists at BNY. We believe it can upskill our people, allow them to do more interesting work, and at the same time partner with clients to grow the firm.
Another record quarter. Dermot, appreciate your time. You've been generous with your time on a busy morning for you and the team. Thank you, sir. The BNY CFO, Dermot McDonogh, following another record quarter, following another record quarter.
Yeah, and talking about how it's both the backdrop, the weather, but also about some of the changes that they've made to the institution over the past 3-4 years. I'm interested about some of the names, Eliza, Claude. I'm wondering
where did they come from?
Yeah, well, I mean, this one actually comes after Elizabeth Hamilton, who was one of the people who was involved in creating this. So evidently it does come from something, but, you know, will there be any children named Eliza and Claude in this next generation?
Hamilton founded the bank, of course.
Yes, exactly.
Yes.
So
right.
this makes perfect sense.
You know, just a little nod towards history.
Thank you. Rather than like founding the AI.
Right. Got it? Okay.
Thank you. I appreciate it.
Anytime.
That was graceful.
That's what I'm here for. Okay. Coming up, we'll get some breaking inflation data, PPI, in about 5 minutes' time. We'll catch up with Stephen Stanley of Santander. He'll break it down for you in just a moment. Equities doing OK on the S&P 500, just about unchanged. In the bond market, yields have been higher through much of this morning. We're off the highs. We're up a single basis point. Your two-year this morning at 420, 10s at 460, up by a couple of basis points. And crude, still elevated. WTI higher by 0.7%. WTI 80, Brent crude at 85. PPI is up next. It's going to be a hot one later on. We're going to get into the 90s here in New York City. It's going to be very hot where England are playing as well.
Yeah, well, that's...
I thought you were staying down there for the game anyway.
I was going to, you know, and then I just was compelled. I couldn't stay away, especially bank earnings.
Did Bastian have the tickets?
He did, but not for me.
Oh, did he?
Yes,
is he taking the team over at Delta?
I don't know who he's taking, but, you know, I tried to throw out. You know, I'd be interested. Wasn't interested.
Yeah, it's going to be hot across the East Coast, that's for sure. Equity futures right now in the S&P positive by a tenth. On the Nasdaq, we're up by about a third. PPI data just crossing. Mike McKee has the numbers. Hey, Mike.
Good morning, John. Well, we had good news for the CPI yesterday, and today we have good news in the PPI, at least for the Federal Reserve, and the inflation fight at the moment. PPI for final demand down 0.3% on the month. Ex-food and energy is up 0.2. That's a tick lower than was anticipated. And food, energy, and trade is up just 0.1%. So that leaves the year-over-year numbers at this point. Final demand headline 5.5. That's down a full percentage point from last month's 6.5. The food and energy core 4.7, down from 4.9, and the PPI ex food, energy, and trade at 5.1%. The index for final demand goods moving down 1.4% in June. That's the largest decrease since July of 2022. And of course, leading the decline, prices for final demand energy. 2/3 of the index, they say, for final demand goods can be traced to prices for gasoline, which were down 12%. And then the index for services rose 0.2%. 60% of that is for final demand trade services, which is, of course, the profit margins for warehouses and retailers. They were up only 0.4%. Half the index is also for on the service side margins for people who sell fuels and lubricants. So the suspension of the war playing a big difference in what's happening in the PPI this month, as well as the CPI. One other number quickly we got for you is the Empire Manufacturing Index rebounds nicely to 15.6 from 5.7, and we saw a big drop in the prices paid index. It falls to 52.3 from 61.0. So we're really seeing that impact of slowdown in prices during the month of June. Now the question is, can we keep it?
Mike, Annmarie thinks you look like a park ranger and wants to know where you are. Where are you?
I'm at the Rocky Mountain Economic Summit in Victor, Idaho, and I will go out and see if I can find her a bear.
Okay.
What's on your shirt?
Stay safe, Mike. Thank you. Michael McKee. And Kevin Warsh doesn't think mission's accomplished, but based on that, it feels like Mike's phoning it in,
Exactly.
taking the rest of the year off.
Well, you might be right. I mean, you could just, head over, get another job as a park ranger.
Clearly, PPI is not a problem. All right, equity futures positive by 0.2 on the S&P, on the Nasdaq higher by 0.5. In the bond market, yields were a little bit higher. Now they're a little bit lower at the front end of the curve, still dancing around 420, 417. Yields lower, Bramo, by a single basis point.
Yeah, a lot of this being driven by energy, but nonetheless, across the board, the idea that ex-food and energy year over year is coming in at 4.7% versus the expected 5.1%. And there were some downward revisions as well to the prior month. This all giving a sense of support to what we saw from yesterday's CPI. That said, the fact that oil prices inflecting back higher again, and given the robustness that we're seeing from Wall Street, again, expect to hear mission not accomplished and some questions down on Capitol Hill, which is the reason why you're not seeing a much bigger move in the bond market.
Thank you for remaining so professional. We appreciate it.
Oh, yeah, me. I'm just the picture of professionality.
Stephen Stanley of Santander joins us now for more. Stephen, good morning.
Good morning.
Thanks for wearing a tie. We appreciate that,
I don't know how I can top the conversation so far.
What's the reaction to CPI to PPI? Are we close to mission accomplished?
Yeah, well, look, the inflation situation is extremely complicated. I think one thing we learned yesterday is it feels like we're getting past the tariff pass-through. So that's one thing we can set aside for now. We've still got the question of how much of the oil shock is going to pass through more broadly into the core numbers. I don't think we have an answer to that just yet. And as Lisa said, you might have thought a couple of weeks ago the oil shock was over. Now we're back up again. So I think that question is still before us. But I think the big issue, and Warsh alluded to this yesterday, I mean, it would be one thing if the core PCE deflator was running year over year 2.4. You say, okay, we're a little above. We're at 3.4. So we get one good inflation number, and to Warsh's point, it's not mission accomplished because we have such a margin that we're missing by that it's going to take a lot to get us back.
This is how we start the show. We know what he doesn't like, OK? What we don't know is what he's willing to do about it and whether he believes we are actually sufficiently restrictive or not.
Right.
Have you got any understanding of that at this point after a day of testimony?
The man of mystery,
right?
Chairman Warsh. Yeah, so I think that...
Is the ambiguity strategic?
Oh, for sure. I think...
What's the strategy?
Here's what I think is happening. So I think Chairman Warsh would argue strongly, and I think most of the people in the committee would agree, that the Fed was using too much forward guidance, basically leading the markets around by the nose. If you think to the Powell regime, and more than likely, if the Fed were thinking about hiking in September, let's say, they would have already been trying to signal it in June. He wants to do away with that. At the same time, he's moved to the polar opposite extreme of, I'm not going to tell you anything. I'm not going to tell you whether I think the economy is strong. I'm not going to tell you what my reaction function is, what I'm paying attention to. Just all I'm going to tell you is we're meeting again in 6 weeks, basically. There's a happy medium somewhere in between. I think my sense is that what he's doing now is he's trying to wean the financial markets off of this steady diet of forward guidance. So we're going cold turkey for a while. And ultimately, you know, whenever, maybe it's after we get the working group results back or whatever, hopefully we'll get to something in the middle.
He has the luxury of going cold turkey because right now the Fed's not in the driver's seat and they don't have more visibility than the market does. So right now it's a great time to go cold turkey because they're not on the hot seat to actually take immediate action. That said, I'm struggling with the cognitive dissonance of the disinflation that we're seeing in these numbers. Earnings coming from the biggest banks showing absolute boon time types of profitability. Also, a separate report from the New York Fed from their general business conditions coming and showing that the employment component rising to the highest level since December of 2022. All of these signs of reacceleration of the consumer and the commentary from some of these executives. How do you square that with disinflation ongoing?
Right. Well, I guess it's disinflation from where? Again, if we're moving, we were, in the high twos for most of last year on year over year for core inflation. We're currently at 3.4. If we disinflate back to the high twos, that's good, but it's still not mission accomplished, right? It's still above the target. I think there are a couple of things that I would say from trying to look at it from Warsh's lens to the narrative that you just explained. The first one is we know the employment situation is a lot better now than it was perceived to be late last year. So when the Fed was easing last year, they were easing because they thought the labor market was soft. And that's off the table now, which allows the Fed to focus entirely on inflation. I think another point that Warsh has been eager to make is he's not a Phillips curve guy. So the Fed as an institution has always been of the view that inflation always and everywhere comes from the labor market. And clearly, the inflation that we're getting now is not coming from the labor market, right? Wage growth is not accelerating, and yet inflation has moved up into the mid-threes. So I think what Warsh would say is, firstly, and this was why people thought he was going to be super dovish before he took office, good growth is not a problem necessarily from an inflation standpoint, particularly when it's being driven by investment. AI should raise productivity over the long run. In and of itself, it's not inherently bad. But if it leads the economy to overheat, then you do get inflation. And so I think he's willing to sit back and see how things play out. But the way that things seem to be playing out, in my view, is we are getting inflation, and the Fed does have to respond to that.
One of the pushbacks that we get from people is that if the Fed were to raise rates by 25 or 50 basis points, it wouldn't constrain some of the main nodes of inflation, which is the AI investment, which is a sort of secular overlay, not exactly monetary driven. That said, whenever we see the prospect of tightening, we see stocks sell off, which is essentially monetary conditions, or, financial conditions doing the work for them. So which is it? Does it have an effect or not if they were to hike 25 or 50 basis points?
Well, I mean, it clearly has some effect at the margin, right? It affects the environment. And right now, I think by any measure, you would say financial conditions appear to be extremely easy. So I think it's hard to make the argument as a policymaker that the funds rate at its current stance is restrictive. I think the consensus view on the committee prior to Warsh coming in was that the Fed was modestly restrictive, and if they could just hold at that level for a long enough period of time, it would bring inflation down. And I think what we're seeing is, certainly financial conditions would suggest the Fed isn't really easy right now. I think that's a reason why they're ultimately going to have to nudge rates higher.
Well, when it comes to when this could potentially happen, do you think they would really make a move before the midterm election?
That's a good question. I think that would actually be exhibit one in Warsh's argument for, hey, we're independent, right? So in some ways, hiking in September, which, would be kind of something that the Fed typically has avoided moving right before the election. But I think moving in September actually bolsters his credibility in a way, especially if there's a strong case for the move. I think where the Fed gets in trouble is when they get really aggressive at a point in time where the case for doing so isn't so great. And that's what happened in 2024, right? The Fed goes 50 basis points right before the election. And, after the fact, Trump is saying, oh, you were being political, right? If a case for moving 50 basis points had been cut and dried, nobody would be saying that. So it depends on the circumstances and whether it's justified. But I think going in September actually would be something that would be good for the Fed's credibility.
What would they need to see?
I think, for me, the number one thing that's important in terms of inflation going forward is this issue of whether the energy costs are getting passed through. I mean, when the first couple of months of the energy price shock, the trucking freight line item in the PPI over 2 months went up by more than 10%. Not annualized, just up more than 10% in 2 months. Everybody assumed that was immediately going to show through into food prices and pretty much anything that has to be shipped. And we haven't seen that yet. I mean, food prices were up 0.2 in May. They were up 0.2 in June, pretty normal type numbers. So I think the jury's out. We're still waiting. But I think for me, as a Fed official, what I'm trying to ascertain at this point is how much pass-through is there going to be. And that's something that the data we'll be looking at the data, of course, but also anecdotes, talking to businesses in the district and kind of figuring out what's really going on behind the scenes.
Stephen, it's good to see you. Thank you, sir. Thanks for being here. Thank you. Stephen Stanley there of Santander on this Federal Reserve. As a softer PPI print follows a softer CPI print and takes some heat off this Fed chair on day 2 of testimony down on Capitol Hill. Equity futures positive. Near session highs up 0.25% with an update on news worldwide. With your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Recapping the data we just got, U.S. producer price inflation unexpectedly decelerating in June, falling 0.3% month over month. PPI excluding food and energy increased 4.7% from the year before. The data suggesting the fallout from the Iran war did remain somewhat contained so far. SpaceX shares are on the verge of falling below their IPO price. Shares of Elon Musk's company closing $1 above their $135 a share IPO price yesterday. The stock has plunged 1/3 from its post-listing peak, erasing nearly $850 billion in value. In sports, Spain are into their first World Cup final since winning the tournament back in 2010. They beat France 2-0 after the favourites, who only managed 3 shots on goal. Spain will meet either England or Argentina in Sunday's final. And that's your Bloomberg brief. John.
Looking forward to the game later this afternoon. Vonnie, thank you. Appreciate it. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with the former US Commerce Secretary, Gina Raimondo, on the massive push to shape the nation's AI future.
The U.S. economy is strong. We continue to be positive on the U.S. economy. There's a lot to be optimistic about. We're very bullish at the U.S. economy. We're very bullish BNY and our strategy. We feel like it's working, and we kind of feel like that we have a lot of opportunity ahead of us.
Back-to-back record quarterly revenue from BNY. That was the CFO, Dermot McDonogh, following a fantastic roundup of Wall Street earnings. Equity futures so far this morning, just about positive going into the opening bell. Stocks up by 0.2%, up by 0.5 on the Nasdaq 100. With your morning movers, some single names. Yahara has more. Hey, Yahara.
Hi, John. Well, Morgan Stanley is bucking the trend that we've seen with some of the other big banks. Actually, not anymore. Shares are down 0.3%, even after the company had posted a strong quarter. Equities trading stole the show. That jumped 69% to a record $6.3 billion. Investment banking also got a boost after the bank co-led the SpaceX IPO. So this wraps up what's been an exceptionally strong quarter for the banks, and yet a lot of them not seeing the jumps that you would think given these strong results. Meanwhile, at BlackRock, we are seeing those shares moving higher, up 5% after the firm delivered a blowout quarter. It attracted $192 billion of new client money. That brings its assets under management to more than $15 trillion for the first time ever. It was helped by strong demand for its ETFs, active strategies, and private markets, all areas that attract juicier fees. And we are seeing BNY shares also slipping this morning, down 1% in the pre-market, despite posting a profit beat. And as you said, another record quarter for revenue. But the stock had already been on a huge run. Just yesterday, it closed at a record high. So it seems a lot of the good news had been priced in. John?
We've seen that movie a few times in the last 24 hours, that's for sure. Yahara, thank you. Appreciate it. Let's turn to this. The AI build-out growing as a political flashpoint. New York State leading the pushback, becoming the first in the nation to issue a moratorium on new hyperscaler data centers. PJM, the largest grid operator in the country, saying data centers have increased supply costs by more than 60%. The former U.S. Commerce Secretary, Gina Raimondo, is leading Raise US, a nonpartisan organization designed to help the American labor force adapt to AI. The Secretary joins us now for more. Madam Secretary, welcome to the program. Let's just start the conversation with the kind of work you're doing and what we need to know this morning.
Good morning. Good morning. So Raise Us is the new organization that I am leading, and our mission is very simple. You know, we want the U.S. to lead the global AI competition, but to have a strategy so that every American worker gets brought along. And right now we're not headed down that path, and it's something I'm deeply worried about. We have extremely outdated infrastructure, social insurance, support for workers, incentives for companies to retrain and redeploy instead of just laying people off. And so I think it's time that we get to work. We're working with governors of both parties. This is a nonpartisan, non-political effort with companies and just trying to find some creative, innovative solutions. Because I will tell you, one of my greatest worries is even if America has the best chips, the best models, the most data centers, but doesn't have an intentional plan to manage this transition and falls into a period of very high unemployment, we will lose the AI race because that will be too destabilizing.
What's your reaction, though, to what New York Governor Kathy Hochul is doing in terms of the moratorium? Because this potentially can slow down how quickly the U.S. can advance in the AI space.
Right. So I think this is a perfect example of what we're trying to do, which is to say Americans are worried, right? They're worried about when the average American hears AI, what they hear is, I'm going to lose my job, my electricity prices are going up, my kids won't have a job, I've just spent money for college. Those are real, legitimate, valid anxieties, and we have to find solutions to address them. So while I don't think, like, no one is happier than the president of China that we are slowing down data center construction. That being said, it's not okay if people's electricity bills are going up, or people's water bills are going up, or people's economic security is going down because of, AI companies. So we must find a way to do both. Steam ahead with data centers and technology and make sure, these companies pay their fair share so other folks' electricity bills don't go up and people have, frankly, a job, a meaningful job in an AI economy.
You recently wrote an opinion piece where you said what we need is a new grand bargain between the public and private sectors. When it comes to AI, what do you make of the Trump administration looking at taking equity stakes, another version of industrial policy that some of which started under the Biden administration?
Yes. So listen, I do think it is a good idea for the American people and the American government to share in the extreme profit and commercial benefit of AI. That being said, I personally have always been a bit of a critic on the government taking big equity shares of companies. I'm still a believer in capitalism, however many flaws it has right now in the way it's playing out in America. And I just, the government owning the means of production is, the definition of socialism. I think it's creates a lot of potential for corruption. So I think the intention is a good intention. Personally, I just get very nervous if we're stepping down a path of like a state-owned enterprise, et cetera. So I'd like to find another way.
How do you balance the idea of trying to create some sort of pact with the U.S. Worker, with the U.S. average citizen, while also maintaining a U.S. edge versus China, right? I mean, do you want to sort of create this sense that there is isolation between the two stacks? I just wonder what the ultimate goal is, what the approach you're hearing from some of the folks you're speaking with.
I think if you talk to the tech companies in AI, many of whom are partners with us and Raise Us, They feel that they're in a global arms race to, get ahead of each other and also get ahead of China and other technologies. And I understand that. But I will say this. If we as a nation put our blinders on, and if every company just moves forward at pace to implement AI, to increase profits without a people strategy, and if we wake up in a couple of years with millions or tens of millions of Americans put out of work because of AI, we will lose the global AI race, because there will be massive regulatory backlash. It will be massively destabilizing to our economy. It'll be recessionary. It'll be massively destabilizing for our politics. So what I'm trying to say to business leaders, to governors, to Congress, to everyone in America is, let's get together and find solutions. Let us be intentional about how we transition to an AI economy, because quite frankly, every American deserves to see themselves productive and having a good job in that economy. And until we convince the people of America that there's a good future for them in an AI economy, you're going to continue to see what you just asked me about, moratoriums on data centers, other kinds of uprising. And that's bad for America. That's bad for everyone in America.
No doubt that debate is going to continue. We look forward to covering it with you. The former US Commerce Secretary, Gina Raimondo there. Madam Secretary, thank you. Unfortunately, that debate, at least for the short term, has been hijacked by the political cycle, with the midterms very much top of mind.
Yeah, and a real question of how much you prioritize trying to win in the race versus understanding how to create a more sustainable path going forward. And you feel this tension, frankly, from some of the earnings and from some of the CEOs that are talking about retraining people. Yes, you have seen cannibalization from certain units, but they've retrained people to go elsewhere. So you're hearing this from the executives as well.
That wraps up earnings season on Wall Street. Take the rest of the summer off. Right? No?
All right, ciao.
No? Okay.
World Cup.
Kevin
Not so
Warsh
much.
coming up in about an hour from now. Look out for that full coverage right here on Bloomberg TV. Coming up tomorrow, fantastic lineup of guests, including the United Airlines CEO, Scott Kirby, from New York City this morning. Good morning to you all. This was Bloomberg Surveillance.